Okay, so hello everyone, and today we would be doing a very important index, that is index 116. We are going to try to do the full revision of this standard and also pick up a lot of important questions that we can touch upon. So this is a tier 1 category standard and one of the most important standards from an overall exam perspective. So let us get onto it. Okay, so let's go to the first part over here. When we are looking at index 116, what does this standard try to cover? This standard essentially covers something called as leases, for which there was a similar standard in your CA Inter, which was AS 19. Now, when you look at leases, earlier you had these two classification for leases. One was operating lease, one was finance lease. When we are looking at, let us say, the definition for an operating and finance lease, there were a bit of certain ambiguous points, like you can always say that there is a finance lease if it covers a major part of economic life, that is more than 75%, or substantially covers the fair value, and hence people would try to manipulate to get a lease into the operating lease category and get a lease into a finance lease category. In the accounting over here will be starkly different. Like in case of an operating lease, the accounting would be rent account debit to bank, and then you transfer the rent to the P&L account. Very simple accounting for lessee. But in case of a finance lease, what would happen is you will take over the lease liability, record an asset, and then record depreciation on the asset and interest on the lease liability. So this was a fairly more complex accounting as compared to, let us say, the traditional operating lease accounting. And in finance lease, what happens is a liability is shown in the balance sheet, an asset is shown in the balance sheet. So a lot of lessees were reluctant to classify their lease into finance lease, and hence they would manipulate in a way their lease term or the useful life in order to ensure that the lease gets classified as an operating lease. And that is the reason why index 116 comes in. Index 116 says, at least from the lessee's perspective, we will abolish the concept of operating lease and finance lease. From the lessor's perspective, we will study, but there's still those concepts. But from a lessee's perspective, we will abolish the concept of operating and finance lease. In which case, from a lessee's point of view, how will a lease be recorded? Well, every lease, whether it is operating or whether it is finance in nature, every lease will be recorded by taking, let us say, the right of use asset and a corresponding lease liability. That is, even if the lease is for 2 years, whether it is for 5 years, whether it is for 15 years, no matter how much, whether it is for a major part of the economic life or not, we will recognize a right of use asset and we will recognize a lease liability. A simple example over here would be, if let us say I am PVR Cinemas and I will take a multiplex on rent where I am agreeing to pay 100 rupees for a period of 5 years, which means I will say that I have an obligation to pay 100 rupees for a period of 5 years, which in present value terms, 100 into the present value factor, let's say at the rate of 10% for 5 years, let us say it comes to 379. So I'll create a lease liability of 379. That is an obligation to pay. But against that obligation, do I get something? Yes, sir. I will get a right of use. That is, I will get the right to use the asset, and hence I will create what is called as a right of use asset. I cannot show it as an asset because I don't own it, and hence I will show it as a right of use asset. So for the 5 years, I can decide when to use the asset, for what purpose to use the asset. All decisions I can take. Like for example, if there's a very hit movie, like for example a Dhurandhar or something, in which case I can run shows throughout the night as well, in which case I have the right to use the asset in the manner I want, and hence I will create a right of use asset and a corresponding lease liability. So when I'm creating this, I will take it as a present value of the lease payments. Now this is something which is the heart of 116. It says in general every lease has to be accounted in this manner, except for two exceptions are given over here. The first exception over here will be for a short-term lease, which is a lease for a period of less than 12 months, and second is for a low value item. That is, if these lease items are of low value, like for example a telephone or a printer or a small office items, in which case exception is given whereby you can show a rent and expense that rent rather than creating a right of use asset and a corresponding lease liability. So in this particular case, how will we do the particular working? Well, as per 116 in the books of the lessee, create a right of use asset, create a lease liability. This will be created as a present value of the lease payments. Are we good till here? Yes. Okay. So all of this accounting will be done, but for this accounting you need to first figure out whether a particular transaction meets the definition of a lease or not. And lease has 4 pillars. First, for leasing something and saying that something is on rent or something is taken on lease, there needs to be something called as an identified asset. So the definition of lease would say that lease is a contract that conveys a right to control the use. That is the first pillar. of an identified asset. Second pillar, for a period of time, that is a lease term. Third pillar, in exchange of consideration, that is a lease payment. So these are the four important pillars. Just a second. So when I'm looking at, let us say, figuring out whether a particular transaction is a lease transaction or not, just give me a second, please. So for something to become, let us say, a lease, there needs to be these four pillars that need to be fulfilled. So first of all, we need to figure out what is an identified asset. An identified asset is an asset which is physically distinct. That means, let us say I'm looking at a new building where there are various car parking spaces. Every car parking space is physically distinct from the other space. Every flat is distinct from the other flat, and hence when I'm looking at assets which are physically distinct, I can say this is an identified asset. Remember, these assets may be implicit as per the arrangement, that is, they are implied. The lessor has only one asset to fulfill this, or they may be explicit, they can be specifically mentioned. They may even be some things which may yet to be manufactured, that is fine. If I'm looking at an identified asset, these are assets which are physically distinct. I have to be able to identify the first flat as compared to the second flat, they are physically distinct. Secondly, if the asset is capacity linked, so over here, when I look at the pillar of a lease, I will say a leased asset is an identified asset which is either explicit, implicit, it can be yet to be manufactured, but it has to be physically distinct. Physically distinct means it is independent. A flat is independent from the other flats. A parking lot space is independent from the other parking lot spaces. It has to be independent. Secondly, it has to be something which is, if it is capacity linked, like a pipeline or something, then substantially all of the capacity, that is more than 90% of the capacity, should be used by the lessee, in which case we can say that lessee has an identified asset. So if it is a capacity linked, then substantially all of the capacity lease, that is more than 90%, will be attributable to the lessee. So for you to say that I've taken something on rent, you should be able to pinpoint and say, what have I taken on rent? That has to be an identified asset which is physically distinct. Secondly, I should have the right to control the use, which means of that identified asset. Let's say a car is an identified asset. For that identified asset, I should have the ability to use the asset in a manner I want. So how will I decide that? Well, the important decisions on how and for what purpose the asset will be used. Like for example, a car, how will the car be used, where the car will be taken, for what purpose will it be used. All of these important decisions on how and for what purpose the car will be used, where and when it will be used, all of these important decisions will be taken by whom? Well, they will be taken by the lessee. So when we are looking at these important decisions have to be taken by the lessee. Now usually if a person is owning the asset, the important decisions on how the asset is going to be used, for what purpose it is going to be used, ideally will be taken by the owner. However, when I give that asset out on rent, then I am not going to question the lessee for what purpose the lessee is going to use, and hence the important decisions on how the asset will be used, for what purpose it will be used, where it will be used, when it will be used, these have to be taken by the lessee. So for the right to control usage, I should say that on using, whatever are the benefits that come. So if I were to take a property on rent, now how many students I get in that property, how much fees I charge, all benefit will go to the lessee. Substantially all benefits from using the asset directly, like earning fees, or even indirectly, like for example getting some grant or a subsidy which is linked to usage, or even something which is, let us say, I don't know, if I were to sublet that and get an income, all of these benefits should flow to the lessee only. So if I have to look at the right to control use, I will say that the right to control use is when substantially all the benefits, whether direct or indirect, from usage accrues to the customer, that is a lessee. Institute calls the lessee to be the customer. And the right to direct use, that is decisions on how and for what purpose the asset is going to be used, are taken by the customer. For such purposes, you will ignore what is called as protective rights. So what are the protective rights? Protective rights would refer to the rights which are in order to protect, let us say, the owner of the asset. Like for example, I can use this asset for the purpose of, let us say, for the purpose of travel. However, if I want to remove, let us say, the sunroof of the car, will that be allowed? No. That is, so you will say that, well, but that is a right which is not given, but that is to protect the owner. And as a result, when we are looking at these rights, the right to control use would mean that the decisions on how and for what purpose the asset will be used will be taken by the lessee, but that will be subjected to certain conditions whereby the interest of the owner, the landlord, will kind of be protected. So currently we want to understand what is a lease. A lease is something which will have an identified asset. What is an identified asset? An asset which is physically distinct, or if it is capacity linked, where substantially all of the capacity is going to be taken by the lessee. Secondly, we have not yet discussed that, but this is an asset. For it to be an identified asset, this is an asset where the owner, that is a lessor, supplier, does not have the right, substantive right to substitute this asset. Like for example, what might happen is you might take a classroom on rent. Now next day morning the landlord says, no, take your students to some other class. No, next day take to some other class. All of these are owned by me. No, he cannot substitute. The entire essence of an asset being identified where you have the right to control usage means even the owner cannot substitute. Like for example, if I were to take a car from a Zoom car or a Rev car on rent when I'm traveling, I can use that same car for the entire duration of the arrangement, and the owner, that is a supplier, does not have the right to substitute. If they do have the right to substitute, then I don't have the right to control use, and as a result, for there to be a lease, there needs to be an identified asset which cannot be substituted by the owner. So the law over here says that supplier does not have a substantive substitution right. Sometimes it might be that the substitution right is just given for the sake of it. However, in substance, it will not be exercised. So we say that that is fine. The right to substitute is in that case not substantive. Like for example, there is a mall that is given out on rent, and there is a HVAC, heating, ventilation and cooling, air conditioning system, the centralized AC system, where the owner has a right to substitute it. But if they substitute, they'll have to break the walls, remove that system, put a new system. It is not economically feasible to do that, in which case even if the right exists to substitute, it is not a substantive right. That is, in substance, it will not be exercised because the cost of substituting will not match up with the benefits that will be there on substitution. So over here, supplier does not have substitution rights. That is, there's no practical ability to substitute, and even if they have the theoretical ability to substitute, there's no economic benefit on substitution. If nothing is given, you will assume that there is no substantive substitution rights. So this is the first pillar. When I say that for something has to be a lease, there has to be an identified asset, means something which is not physically distinct, something which is physically distinct, and something which a supplier cannot substitute. Second, there needs to be a right to control use, which means over here, when you have the right as a customer, you can direct how it is to be used, and all the benefit from the usage will flow to you. So these are the two pillars when it comes to figuring out whether there is a lease. But remember, when there is a lease, that lease is not free of cost, and hence there will be certain important terms, like there will be a lease tenure or a lease term, and then there will be, let us say, a lease payment or a lease consideration. Now for that, we need to understand over here the important terms. We will figure out these terms. There is another component of separation between lease and non-lease components, which we will study in some time. But let us say, if I were to look at the important terms, there are 5 important terms over here. First is the inception date. Second is the commencement date. Now, what does an inception date means? And this is important from an MCQ perspective. An inception date is a date when, let us say, the lease agreement is signed, or principally the terms of the lease have been agreed. The significance of this inception date is this is the date where you will try to figure out whether your arrangement contains a hidden lease or not. Sometimes what might happen is your contracts are structured as regular lease contracts, then there is no problem. But sometimes it might happen that your contracts may be structured as a job work contract or an outsourcing contract, or let us say a power purchase contract, but in that contract there can be a hidden lease. So whether your contract has a hidden lease or not, that needs to be checked on the inception date. And inception date is a date when the lease agreement is signed, or principally the terms of the lease have been agreed. Like for example, it is possible that you sign a lease agreement on 1st April. However, the property is not available for your use till 1st of July. Maybe the landlord has an existing tenant, they will have to vacate, and you will get the property from 1st of July only, in which case the inception date is a date when the lease agreement is signed, that is 1st of April. However, commencement date is a date when you get the right of use. That is, if you get the keys to use the property in a manner you want from 1st of July, then 1st of July for you is your commencement date, whereas 1st of April is your inception date. Now remember, for you, inception date is significant only so that you can figure out whether an arrangement contains a lease or not. However, if you want to pass a journal entry, on which date will the journal entry be passed? The journal entry will be passed on the commencement date. That is the date when, let us say, the right of use is passed, that is 1st of July, is a date when you will recognize the right of use and a corresponding lease liability. Commencement date refers to the date when you get the right to direct use. Sometimes it might happen that on 1st July, the rent starts. However, the landlord is ready to give you the keys from 15th of June itself so that you can do the renovations, etc. So on 15th of June, if you are getting, let us say, the right to direct use, and 15th of June is the commencement date. More important for you as a student perspective is the commencement date. Commencement date refers to the date where the underlying asset is made available for use to the lessee, irrespective of when the lease payment starts. Sometimes what might happen is lessor might obtain you a 6-month rent-free period. Still, the commencement date is a date where you are getting the keys to use the property in a manner you want. Accounting for the assets or liabilities will start from this date, that is a commencement date. So that is commencement date. Then there is an inception date, which is the date of the lease agreement. This is only used to assess if the contract contains a lease or not. So maybe from an MCQ perspective, if this comes, you need to be differentiating the dates, though the entry, if required, is only to be passed from the commencement date. Next is the lease term. Now this is that fourth pillar. When you look at the definition of lease, the next pillar is, well, if I am taking something on rent, that's an identified asset where I'm getting a right to control use for a period of time. So that period of time is defined to be the lease term. Now what will be there in the lease term? Now obviously the non-cancelable period, let us say you take a period of 5 years plus let us say a renewal period of 5 years. So the first 5 years, which is non-cancelable, will definitely be the lease term. However, the question arises that what about the next renewal period? Now the standard over here says that you will only take the renewal period if it is reasonably certain that the renewal will happen. Like initially, if you are uncertain, that is a 50-50 chance, you will not take the renewal period. You will only take if there is a significant economic incentive to renew. When will there be a significant economic incentive to renew? If, for example, there is let us say you have done major renovations, and those renovations will kind of be giving benefits only if you use the property for the entire 10 years, or this is a very prime locality and you want to continue over here for the entire 10-year period, or let us say the rent in the renewal tenure is much more lower than the prevailing market rate. Now all of these kind of showcase a significant economic incentive to renew, and hence in such cases renewal period will be taken. Now sometimes what might happen is when you are looking at, let us say, the lease term, in case of a lease term, you will take the non-cancelable period plus the period covered under the renewal option. And when we are looking at some landlords, they might say that rather than showing a separate renewal period, we will give you a termination option without any significant penalty. That is, you might give me a 1-month notice and leave. First 5 years you cannot leave, but after that, in the next 5 years, it's a cancelable period. If you want to move out, you give me a 1-month notice and you can move out. In which case, on the face of the agreement, the lease term might appear to be 10 years. However, the enforceable rights are only for the first 5 years. After that, if I want to move out as a lessee, I can easily move out by giving 1-month notice, and hence the period under the termination option as well, you will only include that period if there is a significant economic incentive to continue. So generally speaking, when you are looking at the lease term, you will always include the non-cancelable period, but the period under the renewal option or the cancellation or the, let us say, cancelable period, you will only include if, let us say, there is no incentive. You will only include the period under the renewal option or termination option if there's a significant economic incentive for you to continue. Otherwise that will not be taken. Sir, but how does it matter? Is lease term important? Well, it is very important, because when you're looking at the lease term, this is the tenure over which you will take the present value of lease payment. So if it is 5 years, then present value over 5 years, 5 plus 5, 10 years, then you will take the present value of over 10 years. So this is the lease term. Sir, but initially I thought that the lease term will be 5 and 5, 10 years. Later, can I reassess? The answer is yes. In case, let us say, certain events that are happening at a later date, which will make you reassess, maybe business conditions, etc. change, which may make you reassess, and that is very much possible. If you reassess, there is a concept of something known as remeasurement, which will apply, in which case you will have to remeasure the lease liability and the corresponding right of use asset. Now, typically from an exam perspective, this is more than sufficient, though a small technical point is, if there's a termination option, we have to see with whom is the termination option. In our example, we said that the termination option was with the lessee only, in which case, will you include the period covered under the termination? Well, if there's a significant economic incentive to continue, we will include, otherwise we will not include. So include the period under termination if lessee has an economic incentive to continue. If not, I will not include. However, if, for example, if I am looking at renewal option with the lessor only, termination option with the lessor only, in which case if the lessee wants to terminate, lessee does not have a choice. Lessee has to continue, because the option is the lessor, in which case if the lessor does not terminate, the lessee has to make the payments for all the 10 years. And hence if the termination option with the lessor only, then you will include the period under the termination option in the lease term. Why? Because for lessee, if the lessor does not terminate, lessee has to continue to pay. So you have to keep the reader prepared by showing the entire lease term for 10 years. But if the option is with both parties, which is the most common thing in practice, option is usually with both parties, in which case if the option is with both parties, then the period covered under the termination option will not be included in the lease. Assume there is an insignificant termination penalty, in which case this will not be included, for example, within the lease term. Okay, so this is pertaining to, let us say, the lease term. Then comes lease payment. Now when you look at lease payments, these are payments which are going to be included for the purpose of lease liability calculation. So when you calculate the lease liability, there will be fixed lease payments. Like for example, you are agreeing to pay 100 rupees for a period of 5 years, that is fixed lease payment. In fact, there can also be 100 in the first year, 110 in the second year, 120 in the third year, 130 in the fourth year, so on. So over here, these are also fixed lease payments. Remember, they are not equal lease payments, but they are fixed lease payments. You have to pay 100, 110, 120, etc. And hence these are fixed lease payments. So when you are taking the lease payments, we will include the fixed lease payments. Fixed lease payments, remember, would be a part of your lease liability calculation. Now, what do you think about the variable lease payments? Like for example, some of the lease agreements have this arrangement where maybe if there is a variable payment, like it is linked to sales, linked to, for example, production, should you include that variable payment which is linked to sales, production? Well, Ind AS says no, that will not be taken into the lease liability or the right of use calculation, because I don't know if the sales are, if something like COVID happens, sales become zero, I don't have any obligation to pay anything, and as a result, variable lease payments will be expensed to the P&L as and when they happen. They will not go initially into the lease liability or the right of use asset calculation. However, there is an exception to this. Variable lease payments which are linked to, let us say, a rate or an index. A rate can be an interest rate or inflation rate. Index can also be an interest or an inflation index, like a CPI index, for example. If, let us say, this is linked to a rate or an index, then you can take it into the calculation. So when we are looking at, let us say, lease payments, there can be fixed lease payments. They will be a part of your lease payment calculation. Variable lease payments that depend on index or rate. Index or rate over here can be inflation or interest rate, index or rate. For example, when we are looking at the inflation payments over here, the standard believes that usually it is very normal for a landlord to seek compensation for time value. So in the first year, it is not normal for a landlord to seek compensation for your sales or for your production, but it is very normal for a landlord to seek compensation for time value. And hence, if there is, let us say, a payment which is variable, which is linked to, let us say, an interest or inflation rate or interest or inflation index, it is something which is normal. Now for 4 or 5 years, I can foresee what will be the inflation. However, if it's a 20-year lease, for me to foresee what will be the inflation over 20 years is very difficult. And hence, as a landlord, I might say that, okay, your base rent is 100, which will increase by, let us say, the interest rate or the inflation rate or the CPI index, as the case may be, for each of the year. Like in capital gains, you have the CPI index, capital gains index. So Ind AS 116 says this is something which is inherent in a lease, and as a result, if a variable lease payment is linked to, let us say, a rate or it is linked to an index, then I will take it into the calculation. Otherwise, I will not take it into the initial lease liability calculation. Sir, but variable rates will be variable, so how will I know initially? So the standard says that in such case, you will take the rate prevailing on the commencement date. So if, let us say, that it is variable linked to the RBI rate, then whatever is the RBI rate at the commencement date, let's say it is 5%, then you will take an escalation of 5% in each year. Or the CPI index, let's say the CPI index is 120, then the working will be 120. Sir, but they can change later. Yes, you can very well revise this. This revision will happen when the cash flows are actually reset. Like for example, after 1 year, if the cash flows are getting reset and the rate now becomes 6%, then you will take it based on 6%, or CPI becomes 125, then reset based on the 125 CPI. But initially, when you have to calculate the lease liability or the right of use asset, you will take the variable lease payments which are linked to rate or index, taking the rate or index as prevailing on the commencement date, and that rate or index will be revised as the cash flows get reset. You will not keep on revising it on a daily basis or an annual or a quarterly or a half yearly basis. You will revise it when the cash flows get reset. If the cash flows get reset every year, then the rate will be revised every year, for example. So variable lease payments that depend on index or rate. Now, in fixed lease payments, there is something what is an in substance fixed payment. Now, what do you mean by an in substance fixed lease payment? Which means a lease payment which has in a way certain variability. However, it is in substance fixed. Like for example, you might have agreed to a payment of, let's say, I take a classroom on rent and my landlord tells me that if I have less than 100 students, I have to pay 100 rupees of rent. If I have anywhere between 100 to 500 students, I have to pay 500 rupees as rent. And if I have more than 500 students, then 1000 as rent. Now, I might say this is variable and it is not linked to a rate or index because it is linked to the number of students. However, no matter what, even if I have 0 students, I still have to pay 100 rupees of rent, and hence that 100 rupees of rent I can say is in substance fixed. So when I look at a fixed lease payment, I would say that over here, this fixed lease payment will include something which we call as in substance fixed. So over here, fixed payments including in substance, like in our example 100 rupees was in substance fixed. No matter what happens, I have to pay. In a production floor, it might happen that if the question tells you that if you are producing less than 10 lakh units, then you will have to pay 10 lakh as rent. More than 10 lakh units, you will have to pay 20 lakh as rent, in which case I will say that, well, no matter what, I have to pay 10 lakhs, that is in substance fixed. Anything that I pay above 10 lakhs is in a way variable, and that can be said to be a variable lease payment. So fixed lease payments including in substance fixed lease payment. Sometimes there can be lease incentive as well. Now usually the payment is made by the lessee to the lessor. That is usually the lease rent and everything is paid by the lessee to the lessor. But sometimes, let us say our property is not going on rent, and hence in order to induce that property to go on rent, we kind of give let us say an incentive like a rent-free period, or like a joining bonus is there for employees. Like the lessor gives a bonus, signing bonus to the lessee on signing. Now this is a payment going from the lessor to the lessee. This will reduce my lease payments, and hence the fixed lease payment will include the payment that the lessee does to the lessor minus any incentive that the lessee receives from the lessor. So this is minus lease incentives. So these two I would say are the most common and the most important ones. Sometimes your lease at the end of the lease term gives you a purchase option. So I am taking a property on rent for 10 years. After 10 years, I have an option to purchase that property. Now there is a purchase option. Should that payment under the purchase option also be a part of my lease payment? Well, the standard says if it is reasonably certain that the purchase option will be exercised, in which case you will take even the payments under purchase option as a part of the lease term, as a part of the lease payment. But remember, this will also have spillover effects. Like if you are assuming that the purchase will happen and you are taking the purchase option into the lease payment calculation, then while determining the depreciable life, you will now say that the asset is not going to be with you only for 10 years. 10 years is your lease term, but after 10 years, it is likely that you will purchase, and hence for the purpose of depreciation going forward, you will have to take the entire life of the asset. So over here, when you're looking at, let us say the third point, exercise price of a purchase option, if it is reasonably certain to exercise the option. So the exercise price of the purchase option, if it is reasonably certain to be exercised. Okay, in a similar way, we said earlier that the lessee might have an option to terminate, but the termination might come with a penalty, in which case if we are reasonably certain that the termination will happen, in which case the termination penalty will have to be paid. So payments of penalties for terminating the lease if it is reasonably certain that the termination option will be exercised. So this is the fourth item, and the fifth item is something which is very contractual, which is residual value guarantee, RVG. So what do you mean by residual value guarantee? It means that sometimes what happens is, I am as a landlord or a owner giving the property on rent, let us say for 5 years, the property has a life of 10 or 15 years. Now the property will come back to me after 5 years. I'm not giving a purchase option or anything, but I need to ensure that the lessee uses the asset properly, and hence I will put a guarantee that, well, you know what, today the car is worth 10 lakhs. After 5 years, when you give me the car back, it should be worth at least 3 lakhs. If it is less than 3 lakhs, you have to pay me for the shortfall. So 3 lakhs is a residual value for which there is a guarantee. If after 5 years the lessee gives back the property and the value is only 1 lakh, then lessee has to pay for the remaining 2 lakhs. Now some of the lessees said that I don't want this headache that what will I pay after 5 years and everything, so they might agree for a lump sum amount. They might say that forget valuations after 5 years, we'll pay you a lump sum 1 lakh rupees. Then you do whatever is a repair, renovation to get your car back into the normal condition. Let us use with peace of mind. So residual value guarantee, if it is applicable, is the amount that the lessee will have to pay to the lessor in order to maintain or protect the residual value that the asset might have. So for the lessee, the payments we are expected under the residual value guarantee should be taken. So when I look at lease term as a key concept, I will say the non-cancelable period plus the renewal/termination period if it is reasonably certain to continue. If I look at the lease payments, 5 pillars over here, which will be the fixed lease payment, including in substance fixed lease payment minus lease incentive, plus the variable lease payment only if it is linked to a interest or inflation rate or index, purchase option payments or termination penalty payments if it is likely that you will have to purchase or you will have to terminate, and residual value guarantee payments if any. So all of these will go into the calculation of your initial lease liability and thereby your right of use asset as well. So what will not go? Well, there are two things. First is a variable lease payments that do not depend on an index or rate. They will not be taken, variable lease payments. And then there is something called as a non-lease component. Now we are yet to review that, but a non-lease component means if I were to take just a car on rent, I will pay 3,000 rupees of rent. But if I were to take a chauffeur driven car, that is a car with a driver services, then I'll ready to pay 4,000. So when I'm paying 4,000, the extra 1,000 that I'm paying is not for the car. That extra 1,000 is for the services of a driver, and as a result, this is called as a non-lease component. Non-lease component would mean benefits that are accruing, let us say, to the lessee, but they are not for the identified asset. They are due to some other goods or other services, as the case may be. So if there is a payment which is attributable to the non-lease components, and we have decided to show the non-lease component separately, that will not go into the lease liability calculation. That will be recorded like driver expenses as and when the driver renders services. So payments under the non-lease component, assuming a practical expedient, we are yet to study this. That is a shortcut which was not taken. So over here there is all this guidance which is pertaining to a lease payment. So that kind of takes care of the 4 main pillars. When I look at the lease is a contract that conveys the right to control use of an identified asset for a period of time in exchange for consideration. Consideration over here is the lease payment, a period of time is the lease term, right to control use is if substantially all benefits go to the lessee and decisions pertaining to usage are taken by the lessee, and identified assets are physically distinct assets or those assets which are capacity linked where substantially all of capacity is used, and supplier cannot substitute. In such a case, we can say that the asset is taken on a lease. So when we are looking at, let us say, the other few terms, first there are a few dates, then lease payment, lease term, then there are a couple of other terms like initial direct cost. What is initial direct cost? These are costs which are directly incremental on the lease. So if you take the lease, you will incur the cost. If you don't take the lease, you don't incur the cost. Like for example, brokerage, you will only have to pay to the broker if the lease is actually taken. You don't have to pay to the broker if the lease, for example, is not taken. Or for example, you have, let us say, registration fees. You will only incur that if the lease is taken, otherwise you will not incur it if, for example, the lease is not taken. Next, you might have, let us say, there are certain expenses which may appear to be directly attributable, but they are not incremental. What do you mean by incremental? It means that you will have to incur it if the lease is taken, you will save it if the lease is not taken. Like for example, you might put an advertisement in the newspaper that you want a property on rent. Looking at that advertisement, someone connects with you and you get a property. This expense is apparently directly attributable because it is for the lease. However, it is not incremental. So it is not initial direct cost. Why? Because even on that ad, if I don't get a property, I still have to pay for the ad. It is not incremental on getting the lease. It is irrespective of getting the lease, I'll have to pay for the advertisement, and hence items which are excluded from IDC are traveling expenses, advertising, legal fees before execution of the lease. All of these are not incremental. But what is incremental is commission, legal fees for execution of lease, payments to existing tenants to move out. All of these we can say are incremental. So this is initial direct cost, which if required will come. When you do ROU asset calculation, you will, along with the lease liability, also have to take initial direct cost. And the last thing is the discount rate. Now we say that the lease liability will be recorded at the present value of the lease payment over the lease term. So we know what lease payment is, we know what lease term is, but then present value will have to be taken at a discounted. The problem is in a lease agreement, if you go to see, there's no rate of interest mentioned. We have just said that if I'm PVR, I will say that I'm going to take a property on rent from you for a period of 5 years and pay 100 rupees, period, end of story. There is no discount rate or anything given to you. In which case, what will I do? Well, I will take ideally the rate that the lessor is charging me. This is called as a lessor's IRR. So if a lessor's IRR is given, then I will take that. But for that, maybe in most of the leases, I will not be able to figure out what the lessor is charging me, because for that I need to know at what price did the lessor buy the asset, what is the cost that lessor might have incurred, what is the residual value the lessor will get. There are a lot of moving parts. If this is available, I will take the lessor's IRR, also called as the interest rate implicit in the lease. However, if it is not available, then I will take the lessee's incremental borrowing rate, which means lease is considered to be an alternative to borrowing and buying. That is, if I had the money myself, I don't need to lease, I don't need to borrow, I will just go and buy the asset. But because I don't have the money, I have two alternatives. I can either lease the asset, or I can go to a bank, borrow money, and using that borrow and buy the asset. So an alternative to leasing is borrowing and buying, and as a result we will say that the incremental borrowing rate, that is the rate that a bank would charge me if I were to borrow for this purpose, must be similar to what the lessor is charging me. So in terms of hierarchy, I will say that the first preference for discount rate is the lessor's IRR, if that is available, and if that is not available, I will take the lessee's incremental borrowing rate. So this is regarding the discount rate. Okay, now before you go into the actual accounting nuances, you will say that ideally when you look at a lease under 116, how should your accounting happen? Well, ideally we will recognize the right of use asset, we will recognize the lease liability. That should be our ideal working, that should be the ideal way in which you should operate. However, there are two exemptions we said. First is if it is a short-term lease. In short-term lease, you can directly show a rent expense. And when is a lease short-term lease? If the lease term means a non-cancelable period plus a renewal period depending on the conditions. If the lease term is less than or equal to 12 months and there is no purchase option. If there is any purchase option, no matter what the lease term is, it cannot be a short-term lease. And if your tenure is more than 12 months, whether there is or there is no purchase option, it cannot be a short-term lease. So for there to be a short-term lease, which is very commonly used in practice, because in India, most of the leases you might have seen with your clients are those 11-month leases, where the lease term is less than or equal to 12 months and there is no purchase option, in which case you may bypass recording a right of use asset and lease liability and instead just show a rent expense. Sir, but is it compulsory that I have to take this exemption? Answer is no. The standard tells you that you can very well show the ROU asset and the lease liability, or you can take this exemption. So it is an optional exemption for recognition. It is not mandatory that if it is a short-term lease you have to take the rent. You can always say that I still want to show you. What if it is a short-term lease for a building of 11 months? I still want to show a right of use asset and a lease liability. Great, you can still show it. So over here, when we say choice to be exercised on the basis of underlying assets taken on a short-term lease. So there is a possibility that I might have 5 buildings which I have taken on 11-month lease, and I might have 50 items of furniture which are also taken on 11-month lease. So for those 5 buildings, I can show that even though it is for 11 months, I want to show a right of use asset and lease liability. That is fine. But for the furniture, I can very well say that I want to take the short-term lease exemption. That is acceptable. However, within those 5 buildings, I cannot say 4 buildings I want to show using right of use asset, for 1 building I want to show. No, this choice has to be taken for a class of PP, which means class of PP with less than 12 months of tenure. If let us say I want to, for a building class, show a ROU asset and lease liability, that is very much possible. But for a furniture, I want to show, let us say something like rent account debit to bank and P&L account debit to rent, that is very much possible. But this choice is available for a class of PP. So it's a fairly important, I would say, exemption. Then there is a lease of what you call as a low value item. So what happens in case of a low value items? In case of low value items, these are items which subjectively are low value. As if they were new assets, I would say that these are low value items, like a telephone, or let us say a small, like you go to Lenskart, you have these people having small tabs or maybe printers. These are office items which may be individually of a small value. You might have taken this on rent, let us say for 3 years, in which case you don't get the short-term lease exemption. But because these items individually are low value, Ind AS 116 allows you if you want to take a short-term lease, to take a recognition exemption, that is, you can show rent account debit to bank and then P&L account debit to rent, rather than creating a right of use asset and lease liability. Now, the problem over here from a student standpoint is, how will I know whether the item is low value? A lot of times questions tell me that the rent is 100 rupees. Do I judge that it is low value? No. We will not assume an item to be low value unless the question specifically tells me that it is low value. And as a result, low value items have not been specifically defined. The following cannot be treated as low value items: assets which are highly interrelated or interdependent with other assets. Like you look at a tire is highly interdependent with a car. So when I'm looking at the assessment, this will be viewed together. I cannot say tire is low value but car is not. Tire and car are highly interrelated. Or let's say there are head lease. So if the head lease means if you have taken an asset on rent and you are going to sublease it, the first lease is called as head lease, the second lease is called as a sublease, in which case over here we will say that assets which are highly interrelated, or let us say head leases, the choice needs to be taken on a lease by lease basis and not for an entire class. So if let us say this choice is taken, what will happen? Accounting finally in the books of the lessee would be, usually when I look at short-term lease or lease of a low value item where optional exemption is taken, you will show rent account debit to bank, and then this rent will be expensed to the profit and loss account. You do not create a right of use asset, you don't need to create a lease liability. However, in all other cases, what we will do is we'll have to create a right of use asset and create a corresponding lease liability. Now, how do you create the right of use asset and lease liability in your accounting? So this is more important from an exam perspective. Usually you will not get a question on short-term lease or low value item. If it does come, it might come from an MCQ standpoint, but from a descriptive standpoint, it will not really come. So over here, if let us say you had to look at this transaction, we will mostly get questions pertaining to these other cases where you create a right of use asset and lease liability. When you look at the right of use asset, it will be presented along with non-current assets. Some companies show it along with PP, and within PP they show how much of the PP is on right of use. Some companies show PP separately and right of use asset separately, though this will be shown under the non-current asset section. Lease liability will be shown under the non-current liability section, a lot of times under the financial liability, because you have a contractual obligation to deliver cash. However, the accounting principles will be as per Ind AS 116. So when you look at the lease liability, how will you calculate the lease liability? Like let's say over here, you have a fixed lease payment of 100. If there's a variable payment into rate or index, you will take, but otherwise it's a fixed lease payment, let us say of 100, into the present value annuity factor at the discount rate. Let's say this is a lessor's IRR if available, or not, then this is incremental borrowing rate for the lease term. Let us say it is unlikely that the renewal period will be exercised, in which case for 5 years you are taking the non-cancelable period. So this is 100 into 3.7908, and hence this is around 379.08. This will give you your lease liability. So how do you measure the lease liability? It is a present value of the future lease payments as defined earlier under the lease term, like 5 years, again as defined earlier, discounted at the interest rate implicit in the lease. So this will be your lease liability. Sir, but what happens if I initially set up my lease liability at 379? Will it continue to remain 379 till perpetuity? Answer is no. You will have to, ultimately you know that you have to pay 100 rupees over a period of 5 years, and hence this lease liability will slowly have to unwind. You have actually bound the 100 over a period of 5 years. You have taken it into present value and you have bound it and shown it, for example, at 379. Slowly as time passes, you will recognize interest. So over here you will have years 1, opening liability is 379, on which interest will be charged at the rate of 10%. For example, this is 37.9, and lease payment will be reduced 100, and you will get a closing around 200 and something. Similarly, this will keep on going for each of the years. So your lease liability would change due to interest payments each year. It would change due to lease payments in each year. So these are the two reasons why it will change usually. However, there is a possibility that initially you thought that the lease is going to continue for 5 years. 2 or 3 years down the line, you now believe that the renewal option will be exercised. Let's say you do a major renovation or you do some work which now makes you believe that the lease, let's say renewal, will, let us say, be exercised. In which case your revised tenure, maybe 5 years ka lease tha, 2 years had gone by, 3 years were remaining. We believe that beyond those 3 years, another 5 years also we will continue to renew, and hence the revised lease term will be 8 years. In which case you will now have to find the revised lease liability. We will review how to do that for the remaining 8 years and compare it with the existing lease liability, and hence there will be a lease liability, and that lease liability will kind of change. So the impact of a reassessment or a lease modification will also have to be seen, and from a final CA perspective, there is a high possibility that you might get a question pertaining to studying the impact of these lease reassessment as well as modification. The subsequent accounting for lease liability would be similar to the accounting for financial liabilities on an amortized cost basis. So over here, when you're trying to measure the lease liability, this lease liability will be measured considering, let us say, these changes. Now, what will be your right of use asset? 116 says that what you are going to pay for the liability is actually the cost for your right of use asset, which means if you are telling the world that I have to pay 100 rupees for a period of 5 years, then the present value of that 100 for a period of 5 years, which means that is around 379, which is the cost for you to obtain that right of use. So ideally the right of use asset will be the same as the lease liability. However, for obtaining the right of use, this is just one part that you have to pay. Let us say you have to pay to the lessee. However, you might have to appoint a broker to get the asset, and hence some initial direct cost may also be a part of your right of use. Maybe the asset that you take on rent, you will have to restore it back when you go out, and you'll have to incur a site restoration expense. Maybe you constructed a wall in the middle, you'll have to dismantle that wall. So there will be certain site restoration obligations. All of these will impact your right of use asset. Remember, to the lessee, I have to pay 100 for a period of 5 years, end of story. But to get that property beyond this 100 for a period of 5 years, you had to pay certain initial direct costs for broker, etc. Whatever work that you are doing, you will have to restore the site back when you give it back to, let us say, the lessor, and hence that is also something that you will have to consider. So when you look at the measurement of a right of use asset, we say ROU asset should be measured at cost, which will include the lease liability plus the initial direct cost plus the present value of site restoration obligation. Now apart from that, remember, you record the lease liability on the commencement date. Right of use asset is recorded on the commencement date. Now it is possible that there may be certain payments that you might have made or certain amounts that you might have received prior to the commencement date. That is, on inception, you might have paid a token amount to the landlord, or the landlord might have given you certain lease incentives. These on the inception date is before the commencement date. You have not recorded a right of use asset or a lease liability, so temporarily they will be shown as, let us say, expenses pending capitalization. So you might have paid, let us say, 20 rupees on signing, but that 20 is to obtain the right of use, and hence your entry will be expenditure pending capitalization account debit 20 rupees to bank 20 rupees. And once you take the asset, then your right of use asset account debit to lease liability, to site restoration, to bank for initial direct cost, to, let us say, you will now reverse the expenditure pending capitalization, and all of that put together will give you the right of use asset. Now, why will the right of use asset change? Well, right of use asset over here will change due to subsequent depreciation, due to subsequent impairment. So there may be accumulated depreciation, accumulated impairment, and that will give you, let us say, the carrying value for, let us say, subsequent recognition of your asset. Now on this carrying value, why will the carrying value change? Well, you might have taken the right of use asset, you for 5 years, you will have to depreciate it for 5 years. Maybe you have taken it on a non-cancelable basis, and something like a COVID happens, there can be a possible impairment. The recoverable value, you can't sell it, but you can use it, the recoverable value might fall, so there can be an impairment as well. So the reduction, similar to PP, will be due to depreciation, due to impairment. However, in this case, remember, this is a lease, and hence you might have said that I've taken it on rent for 5 years, for which I have to pay a lease liability. 2 years have gone by, 3 years are remaining. You might now reassess and say, I'm likely to renew it. If I renew it, I will have to pay more rent for another 5 years, but I will also get a more right of use for another 5 years, and hence, due to, let us say, a lease remeasurement or a lease renegotiation or modification, as the case may be, your lease liability can change, and so can your proportionate right of use asset. So adjustment for remeasurement of lease liability due to reassessment or modification, as the case may be, and this will give you what we say is the adjusted carrying value. Now, while you are doing depreciation, a small thing that we discussed earlier also has to be taken care of. your depreciation will usually be over what? So that will be usually over the lease term. So depreciation will be generally over the lease term. However, in case there's a purchase option which is likely to be exercised, then the depreciation will be over the entire purchase option, and that is the entire life, because if purchase option is exercised, the asset will entirely become yours. So which is expected to be exercised by the lessee, then the asset will continue to be with the lessee for the entire useful life, and hence ROU asset should be depreciated over the entire useful life in such cases. Okay, now there are a couple of special cases before we kind of go further, and we might try a few questions as well so that you kind of get a broad understanding of what is happening. But let us say before that, a special case over here would be in case the question tells you lease payments are in arrears. What does it mean? Arrears means these payments are made at the end of the respective periods, 5 years, then end of each of those years. If let us say it is given that lease payments are made in advance, which means they will be at the beginning. But the lethal issue over here is, what if the question remains silent? If nothing is specified. If nothing is specified, you will not directly take an assumption. You will first look at the hints given in the question. Sometimes the question tells you that your lease payments are to be reset due to inflation, and they will tell you, for example, the lease payment due on 1st January will be reset as per, which means payment is on 1st January, that is at the beginning. So if we are looking at a question, we will first look at possible hints, or there are certain payments which are given out of the 5-year lease which are happening at the beginning. Then you will say that if few of the payments are happening at the beginning, it is reasonable to assume that the other payments must also be happening at the beginning. So if there are certain hints available, you use that. If nothing is available, you will take a note in the exam and write, well, the note over here can be, you can assume these payments at the beginning, you can even assume it is end. Usually at most places we take end, and hence we will usually solve considering these payments at the end, saying alternatively they can also be taken at the beginning. So if hints are given, assume as per hints, but if no hints are given, assume at the end with a note for an alternative possibility. So this is if you have to identify when the lease payments are made. And secondly, there's an overlap which is possible in case of, let us say, foreign exchange and the lease standard. Like you might have an asset which is located in a foreign country, in which case you might have to pay lease rentals in a foreign currency, in which case if you have to find a lease liability, you will still calculate it as a present value of the dollar payments discounted at the dollar rate. So your lease liability will come in dollars, but you'll have to convert it into rupees. So you will convert it at the exchange rate prevailing today, the spot rate prevailing today, and hence you will calculate the ROU asset and the lease liability considering, let us say, the spot rate today. Now going forward, remember, right of use asset is a non-monetary item. Like a PP is non-monetary item, this is also non-monetary item, so it will continue at the historical rate only. However, the lease liability is a monetary item because you have an obligation to deliver, let's say, $100 each year, in which case it is a monetary liability, and hence Ind AS 21 monetary principles will apply, that you will have to reconvert the liability at the end of the period at the closing rate. Interest will be converted at the average rate. Lease payment will be converted at the rate on the date when the payment is made. So ideally the steps that you will follow in case there is a foreign currency asset will be, you will first calculate the lease liability today, that is the same as the ROU asset, converted at the spot rate today. Once that is done, your ROU asset is calculated, you depreciate it each year, no problem in that. But when you find the lease liability, you will prepare a table for the lease liability in dollars, because actually you have a contractual obligation to deliver dollars, and hence you will have to prepare the amortization table in dollars. Opening liability plus interest minus lease payment gives you closing. Your closing will be converted at the closing rate because it is a monetary item. Interest will be converted at the average rate, and the lease payment will be converted at the rate on the date when the payment is made. Now, because different items are converted at different rates, like opening was at opening rate, closing at closing rate, interest is at average rate, lease payment is on the date on which the payment is made, your answers after conversion will not reconcile. So if I were to make this data in rupees, your opening in rupees plus interest in rupees minus payment in rupees will not actually equal to the closing in rupees as per Ind AS 21, and the balancing figure in such a case will be taken into foreign exchange gain or loss in the P&L account. All the foreign exchange gain or loss from a monetary item will be taken into the profit and loss account. So in case leases are denominated in foreign currency, the right of use asset will be shown at the historical rate, whereas the lease liability, which reflects a determinable amount of cash payments, will be shown at the closing rate, with forex gain or loss being taken to the profit and loss account. So this kind of takes care of the initial basics of lessee accounting while understanding the important terms which are also there for the lessee accounting. Now, before we go to the lessor accounting or the questions, I want to also discuss the part of separation between lease and non-lease components. Now, at this stage, what do you mean by a lease component? What do you mean by a non-lease component? A lease component would mean a component where there is an identified asset. Like for example, if I were to take a furnished flat on rent, I will get an identified flat, that is a lease component which is physically distinct, and identified furniture. Again, it is a lease component because it is physically distinct furniture. However, I am quite lazy, so I want this flat to be maintained, to be cleaned, and I want common area maintenance as well. So I tell the owner that I want the flat, I want the furniture, but I also want someone to do the housekeeping, maintenance, cleaning, etc., which let's say the landlord is ready to do, for which obviously I'll have to make a payment. So over here, for this maintenance or cleaning, I am not having any identified asset. Yes, I'm getting a benefit, but not an identified asset. So this is called as a non-lease component. So when I look at a contract which has multiple components, I will have to figure out whether a particular component inside the contract is a lease component. Like building is a lease component, furniture is a lease component. However, payment, because I want the maintenance done, is a non-lease component. So I have to segregate a contract which has multiple components into lease as well as non-lease components. In fact, there may be certain components which are agreed in the contract which may be neither lease or non-lease components. Like for example, when the agreement was entered, the landlord might mention in the agreement that you also have to pay me for property taxes, you also have to pay me for insurance. But insurance is not my expense. It does not give me as a lessee any benefits. Why? Because if someone were to happen to the property, the compensation will not come to the lessee. The compensation will go to the landlord only. So if I show an insurance expense in my P&L, the reader is entitled to believe that, oh, that means I'm going to get the benefit of insurance. No, you are not going to get. And as a result, I am just paying to the landlord. Against that payment, I am not getting a separate identified asset, nor am I getting a separate goods or services. Sir, but a payment is done. Maybe that payment is shown as for insurance, for property taxes, for administrative charges, but that does not give me any benefit. Remember, whether it's a lease component or a non-lease component, it has to give some benefit to, let us say, the customer or the lessee. Like a building gives us some benefit, furniture gives some benefit, even maintenance, a driver in case of a car gives some benefit. However, if there are certain components like an insurance or a property tax or an administrative charges which are charged, they don't give a separate benefit, in which case they are neither a lease component nor a non-lease component. So whenever you see a contract which has multiple components, you first have to identify which all components in that contract are lease. How will I know, sir? Well, there has to be an identified asset. Which all contracts are non-lease? How will I identify? Well, it gives me benefits, but not right to use an identified asset, and neither lease nor non-lease component, in which case there's no benefit only that I'm going to get because of that component. So I'll first have to identify between lease, non-lease, and neither lease or non-lease components. Okay, once I do that, the question is, should I show all the lease components separately? So should I show the building and furniture separately? The standard says ideally yes, unless you can show me that these are highly interrelated. If they're highly interrelated and interdependent, then you should not separate them out. You can just show them as a combined item. However, if they are highly interrelated, then you will not separate them out. They will show it separately. Like for example, if I were to take, we have seen a movie like KGF, where let's say there is a mine. If I were to take, let us say, a lift or an excavator which goes down in the mine, along with the pulleys, ropes, the related attached accessories, I will say that the lift or the excavator along with the pulleys and ropes are highly interrelated, and hence I will not separate them out and show as two separate components. I will show them as a single overall lease component because they are highly interrelated. However, the building and the furniture, though having some interlinkage, cannot be said to be highly interrelated, in which case I will show the building and the furniture separately. If there are multiple lease components which are not highly interrelated, you don't have a choice. You have to separate them out and show it separately. If there are multiple lease components which are highly interrelated, again you don't have a choice. You have to combine them and show it as a single component only. Another example of highly interrelated would mean if I'm giving a mall along with the centralized air conditioning HVAC system बोलते हैं इसको on rent, in which case I will say that the mall and the centralized air conditioning system are highly interrelated, and if they're highly interrelated or highly interdependent as a case may be, then I don't need to kind of separate them out. However, if there is some furniture or office equipment that can be said to be having some interrelation but not high interrelation. So when we look at multiple components like a furnished flat, the right to use each asset is considered as a separate lease component. Separation will be done for lease components if lessee can take the benefit and the underlying is not highly interrelated. Then you have to separate. Separation is mandatory. Practical shortcut for non-separation does not apply here. Okay, so what is this non-separation? Well, if there are non-lease components, like for example, maintenance, along with building and furniture, or drivers, along with, let us say, car, these are called as non-lease components. The standard over here says that ideally non-lease components should be shown separately. By default, if nothing is given, you will show them separately. You will segregate somehow. You will allocate the consideration to the building, you will allocate some of the consideration to the furniture, you will allocate some of the consideration to the maintenance. However, if you take a one-time choice that I don't want to show the maintenance separately, that is fine. No questions will be asked. This is called as a practical expedient. Practical expedient means conditional shortcut. You are given a shortcut whereby you can say that, well, you know what, I don't want to separate it out. I will just show the building and furniture. I don't want to show maintenance separately. Ideally, if nothing is given, you should show it separately. However, if you don't want to separate the non-lease component, a choice is available, in which case the total consideration will be allocated between, let us say, the building and furniture, that is the lease components only. So separation of lease components from non-lease components. A lease may involve agreement to purchase other goods or services. Separation needs to be done for the non-lease components as well, and the accounting for non-lease components would be based on the respective index. Remember, driver's expense or a maintenance is not covered by index 116. It will be accounted as per the respective index, and if there's no index, then as per accrual, that is as and when the maintenance happens, you will record an expense accordingly. We will do, let's say, numericals and sums for that as well. So over here, optional exemption of a shortcut to not separate the non-lease component is available to the lessee. Remember, this is available only for non-lease components, which means if there were three components, that is a building, the furniture, as well as maintenance, I may decide to show them as three separate components and allocate them to each of them, or I might decide that I don't want to separate out the maintenance, in which case there will be only two components. Remember, such a choice is not available for furniture. For furniture, if it is not highly interrelated, you have to separate. So you have to be careful about it. Okay, sir, we can find out first the components. We can figure out whether they need to separate. For lease component, you have to separate if they are not highly interrelated. You cannot separate if they are highly interrelated. For a non-lease component, the standard says that you will have to probably separate if nothing is given. But if you don't want to separate, a choice is available. But if you separate, let us say I'm paying a total 2 lakh rupees for everything. How will I allocate? Well, in the agreement, they can mention anything. They can say building is for 2 lakhs, everything else is free. The law says you will allocate not based on the agreement. You will allocate the total consideration that you have to pay, considering the standalone price. Now, standalone price is a relatively new concept, which is used in Index 115 as well as Index 116. When you look at the standalone price refers to the price which I would charge if I were to only give the unfurnished building on rent, or only the furniture, or only do the cleaning. So your allocation will be based on the observable price which I will charge if I were to just give a particular asset standalone. Sometimes what might happen is you might not have a observable standalone price, in which case you will take the fair value. So over here, when you are looking at allocation of the consideration, allocation should be in the ratio of the standalone price for each component. In case the standalone price is not available, entity can estimate the standalone price by finding the fair value in case it is not available. Acha. Even over here, this is point C. So point A over here was pertaining to lease components, point B is non-lease component, point C is other items which are neither lease or non-lease component, like insurance, property taxes, etc. So if I look at the summary over here, if there are multiple components in the lease agreement, you will first figure out whether they are lease components or non-lease. Lease components means there should be an identified asset like a building or a furniture or a car. Non-lease components means there should be certain goods or services, but like a driver's or cleaning, etc., but no separate identified asset should be there. If there's a lease component, if they're highly interrelated, you cannot separate. If they're not highly interrelated, you have to separate. There's no choice available. If nothing is given, we assume they're not highly interrelated and hence we'll have to separate. There is no choice for non-separation. If they are not highly interrelated, you have to separate. But when you look at the non-lease components, you will separate by default. That is, if nothing is given, you will separate and show the non-lease component. But if a choice is taken, you may not show separation. If nothing is given, then what do? Then you will always separate the non-lease component. This is the practical expedient, that is a shortcut, is that you will not separate. But if nothing is given, then it is better if you were to separate. So here this is practical expedient not taken. If nothing is there, that means you will not take the shortcut. Sir, what is the shortcut? I don't want to separate. But if nothing is given, I will generally say that I will prefer, let us say, to separate. So this kind of takes care of the first section of this Ind AS. Okay, so what we'll do is we'll review a few questions before we go back. There are a few questions in our super 149, but what I would do is I will just kind of run through a few other questions as well so that you get better clarity. So let us review this. So there are a few questions. Question number 3 is essentially on figuring out the substantive substitution rights. So there is this case where there's an electronics data provider provided servers to a centralized data center that involves the use of a specific server. So that is server number 10, physically distinct. The supplier maintains many identical servers in a single location, and at inception of the contract, it's permitted to and can easily substitute another server without the customer's consent. So the server may be physically distinct. However, they are saying that the supplier can substitute this server easily, and hence the supplier has substitution rights, and hence there cannot be an identified asset. Supplier would benefit economically from substituting because doing so would allow them to optimize the performance. Maybe they can earn more profits only at a nominal cost. In addition, the supplier has made it clear that this is a negotiated right, which is an important right in this arrangement. Whether substitution rights are substantive? Well, yes, they are substantive. They can substitute, and hence, is there an identified asset? No. See, remember, for an identified asset, it has to be physically distinct, which it is server number 10. However, the supplier should not have the right to substitute, which it seems the supplier has. Scenario B, if the same facts are there in scenario A, except that server 10 is customized and supplier does not have the practical ability to substitute the customized asset. So over here, you cannot substitute. Additionally, it is unclear whether supplier would benefit economically from sourcing a similar asset. Whether substitution rights are substantive, answer is no. And whether there is an identified asset, again in this case answer is yes, because there is a physically distinct asset, server number 10, which cannot be substituted, and hence that is the definition of an identified asset. Okay, next you have another question which I would say is relevant. Just a second. You have question number, you can just focus on the screen. Over here there is 16, which is on allocation. A lessee enters into a lease of an equipment. The contract stipulates lessor will perform maintenance of the leased equipment and receive the consideration for that maintenance service. So there is a benefit which is on maintenance. The contract includes fixed prices for the lease and non-lease components. So this is 80 and 10, that is 90,000. That is the total payment. Assume standalone prices cannot be observed. So lessee estimates the fair values of lease and non-lease components. So that is for 1 lakh. Around 85,000, that is 85% allocation is to the lease components, and 15,000, that is 15% allocation is to the non-lease component. In which case, if I were to do this working, this is, well, I would say 90,000 into, let's say 85 by 100 will be around 76.5, which is attributed to the lease component, whereas 90 into, for example, 15 by 100 comes to around 13.5, which will be attributed to the non-lease component. So allocation of the total consideration, that is 90,000, in the ratio of the standalone prices is the principle that you apply over here. Okay, next you have this question pertaining to lease term, identification of lease term. A lessee enters into a non-cancelable contract with a lessor to lease a building. Initially the lease is for 5 years, and lessee has an option to extend by another 5 years at the same rental. So there is a 5 plus 5. To determine the lease term, following factors are to be considered. Market rentals for a comparable building in the same area are expected to be increasing by 10% for the 10-year period. This is for a comparable building. At the inception, lease rentals are in accordance with market rents. However, you have been clearly told that the option is to extend the lease term at the same rental, which means here I am where every other building the rent will go up by 10%. In my building the rent is not going up by 10%, and as a result this is a favorable possibility. Second, the lessee intends to stay in business in the same area for at least 20 years, and the location of the building is ideal for relationships with customers and suppliers, and hence there seems to be a significant economic incentive to continue, and hence the lease term will be 5 plus 5, that is equal to 10 years. Okay, then you have, let us say, a question which is pertaining to, let us say, variable lease payment. An entity enters into a 10-year lease of a property. The lease payment for the first year is 1000, and the payments are linked to CPI. Now consumer price index, so it is linked to, let us say, an index or a rate. That is not a floating rate. CPI at the beginning of the first year is 100. These payments are updated at the end of every second year. This is very important. Your lease payments are not updated annually. They are updated at the end of every second year. At the end of year 1, the CPI is 105. At the end of year 2, the CPI is 108. What will be included in lease payments? So let's say at the commencement date, when you calculate, you will say, well, you'll have to pay 1000 into CPI at the commencement date, which is 100 divided by 100, which is equal to 1000 only. So for each of the years, it's from years 1 to year 10. In each of the years, you will take this same 1000 only. Now when you go to year 1, you will be tempted to do 1000 into 105 upon 100. This is wrong. Remember, you will reset it only when the cash flows are reset. Currently the cash flows are not reset, so you will still continue with 100 divided by 100 only. So 1 year has gone by. For the remaining 9 years, your payments will be, for example, 1000 only. Sir, but the CPI is getting reset. CPI cash flows are not getting reset. See, interest rates, inflation rates can change daily. Does that mean that you will revise the cash flows daily? No, the standard says you will revise it when the cash flow is reset. So over here, when I go to year 2, is my cash flow getting reset? The answer is yes. And as a result, into 108 upon 100, which will come to, let us say, 1080. So your cash flows are getting reset and you have 1080, which will be the payment for the remaining 8 years. So over here, so, and hence the lease payments for all the remaining years are to be updated to 1080, and hence the lease liability needs to be remeasured. Okay, so this is another case. Then you have this question which is pertaining to a variable lease payment. Just for understanding, entity L enters into a lease for 10 years with a single lease payment payable at the beginning of each year. 10 years with a single lease payment payable at the beginning of each year. So the first payment will be at year 0. Second payment will be at the end of year 1, that is start of year 2, and so on. So the last payment will be at the start of year 10, which is the same as end of year 9. The initial lease payment is 1 lakh. These payments will increase by the rate of LIBOR each year. So this is a rate. So lease payments will increase by the rate of, let us say, LIBOR each year. At the commencement date, LIBOR is 2%. Okay, so you will take that into consideration. Assume that the interest rate implicit in the lease is 5%. Find the lease liability to be initially measured. So I will take the LIBOR at the commencement date. Remember, so there's a variable lease payment, but it is linked to rate or index, and hence at year 0, the first payment that you will release will be immediately, this is 1 lakh at year 0. Second will be at 1,02,000, then plus 2% in each of the periods. You will keep on doing till you reach year 9 end. Remember, payments are made at the beginning, which means payment of the 10th year will be made at the start of the 10th year, which is end of the 9th year, and these will be your payments. You discount it at the rate of 5% to get your lease liability. This is regarding lease liability if there's a variable lease payment. Question which we did earlier had a CPI. This question had a rate. So that is a nuance. Next, you have the right of use asset. So when you're looking at, for example, the right of use asset, just a second, please. So this is regarding a good question. Then you have question number 34. This is pertaining to the right of use. Like earlier was pertaining to lease liability. This is pertaining to right of use. Entity Y and Z execute a 12-year lease of a rail car on the following terms on 1st January 16. This is when they execute. The lease commencement is happening on 1st of February. So this is, let us say, 1 year, 1 month window. Y must pay Z the first monthly rental of 10,000 upon execution. Execution is happening on 1st January. This is before the commencement date. And Z will pay Y 50,000 cash incentive to enter into the lease upon lease execution, again on the inception date. Lease execution is 1st of January 16. Entity Y incurred 1,000 of initial direct cost which are payable on 1st of February. Entity Y calculated the initial lease liability as the present value of the lease payments discounted using its incremental borrowing rate, because interest rate implicit in the lease cannot be determined. That is fine. See, you want to find the lease liability, usually you calculate it as the present value of future cash flows. So considering all of that, the liability comes to 8,50,000. How should the lessee company measure and record this lease? Well, if I were to calculate the ROU asset, see, first of all, on 1st January 16, you will pass the entry expenditure pending capitalization account debit. I'm just doing it in short. You don't expenditure pending capitalization account debit 10,000 to bank 10,000. See, ideally I am paying 10,000, but I cannot debit the right of use asset because the commencement date is 1st of February. Also, I'm receiving a lease incentive. I cannot adjust anything because still the asset is not being received. So bank account debit to, let us say, expense or income as a case may be, pending capitalization. Let us say, rather than showing all of this, you can create a temporary account like a ROU adjustment account. Let us say you can create an ROU adjustment account. ROU adjustment account for another 50,000. Now on the date of commencement, 1st of February 16, I will recognize the right of use asset, ROU account debit to bank. I will pay 1,000 as initial direct cost. To lease liability, I will record 8,50,000 as my lease liability. And then there is this ROU adjustment account which has a net debit balance of 10, credit balance of 50, which means a net credit of 40, which will now be adjusted. So this will be ROU adjustment account debit, let us say 40,000, and hence if I go to see, this will come to 8,11,000. So the question is asking you, how will the ROU asset be recorded? Well, we say ROU asset is recorded as your lease liability plus the initial direct cost, that is 1,000, plus PV of site restoration, which is not there over here, plus payments that you had to make before the commencement date, because they did not go into your lease liability calculation, minus lease incentives before the commencement date. All said and done, you will end up with around 8,11,000. Okay, next you have this question number 36. This is a fairly basic question, I will say. ABC, who is a lessee, enters into a 3-year lease of equipment. They agree to make the following annual payments at the end of each year. So these are 20, 30 and 50 at the end of year 1, 2 and 3. For simplicity, there are no other elements. So this is explaining there is no other element. There's a discount rate of 12% and that's about it. So what do I do? Well, you have to show the accounting for each of the years, in which case you initially sit to find the lease liability. It is a concept builder category where you try to find the lease liability as the present value of the lease payment. So this is year 1, 2 and 3. Present value of 20,000, 30,000 and 50,000 discounted at the rate of 12% will come to 77,000. So initially your lease liability and your right of use asset will be recorded at around 77,354. Going forward, what will happen? Well, your ROU asset will be depreciated. 77,354 divided by 3, it will be depreciated at 25,784 in each of the years. 25,784 or 785 in each of the years. And on the lease liability, there will be interest at the rate of 12%. 77,354 into 12%. Your interest will be 9282. This will be your interest. And there will be a payment of 20,000 in the first year. So over here, you are just getting accustomed to how do you calculate the right of use asset and lease liability initially, present value of the future lease payments, and then every year you will have to depreciate and you will have to calculate your amounts. Just a second, please. Okay, so over here, this is question number 37. It's a good question, I would say. Here institute has clarified and made it more clear. We have just tried to keep the old version so that if there's an ambiguity in the exam, you should know what is to be done. EFG, it's a good question. We'll do it aram se. EFG enters into a property lease with entity H. The initial term of the lease is 10 years with a 5-year renewal option. So 10 plus 5, I don't know whether 5 there's a significant economic incentive, then you will take, otherwise no. The economic life of the property is about 40 years. See, lease term is 10 years maybe 5 years more, but the economic life is 40 years. The fair value of the leased property is 50 lakhs. EFG has an option to purchase the property at the end of the lease term for 30 lakhs. Now, there is a purchase option in this case which is available. The first annual payment is 5 lakhs with an increase of 3% every year thereafter. So, this is fixed lease payment where it is increasing by 3% each year. The implicit rate of interest is 9.04%. So, you'll use it for the purpose of discounting. H gives company EFG an incentive of around 2 lakhs which is payable at the beginning of year 2. Okay. So, there's an incentive payable at the beginning of year 2. It is given over here at the beginning of year 2, which is used for normal tenant improvements. EFG is reasonably certain to exercise the purchase option. Achha, if they are reasonably certain to exercise the purchase option, let us say at the end of 10 years, you will exercise the purchase option. You don't need to renew any further because the asset will become yours only. How would EFG measure the right of use asset and the lease liability over the entire lease term? So, first of all, we need to find the lease liability, which is the present value of the future lease payments. Now, how do you calculate lease liability? Well, the payment is 5 lakhs, but the first annual payment, have they told you whether the annual payment is made at the beginning or at the end? At least in this question, no. If you now open the institute study material, you will see a similar question where they have given you very clearly where this payment is at the beginning or at the end. But I have deliberately not taken it because in the older versions of the study material, they had kept it open. So, in the exam, if it is open, then you should know. So, ideally, the question should tell you, like in the earlier case, they told you payments are made at the end of each year. Then it is very clear. If they tell you, like in one more earlier question, payments are made at the beginning of each year. Where is this? At the beginning of each year. Then you know. But if the question remains silent, then you will first look at possible hints. At least over here, they have told you that one of the payment is happening at the beginning of year 2, which means maybe we can assume that the other payments are also happening at the beginning of the respective years. Now, one can always counter this and say that it is not necessary. Well, I can also counter and say the other assumption is not necessary. So, this will go into an never-ending loop. So, generally what Institute had done, even in the older version, is they had assumed payments were made at the beginning. Maybe the only thought process that goes over here is maybe one of the payments was made at the beginning, so they're assuming other payments might also have been made at the beginning, and that is what Institute had done. So that is what we will also try to do for the same. So when we look at this particular calculation, we will say that we'll first find the lease payments. Let us assume the payments are made. There are 10 years. Payments are made at the start of each year. So the first year payment will be made at the start of the first year, that is at year 0. Second year, the payment will be made at the start of the second year, that is end of year 1. Third year, the payment will be made at the start of year 3, that is end of year 2. Fourth year, payment will be made at the start of year 4, that is end of year 3, and so on. So the first payment is 5 lakhs, and then 5 lakhs plus 3%, that is 5 lakh 15 will be paid at the start of year 2 or end of year 1. But when you are paying 5 lakh 15, you are also getting a lease incentive of, let us say, 2 lakh rupees. So initially 5 lakhs, then 5 lakh 15 minus 2 lakhs, and hence net 3 lakh 15. Achha, then 5 lakh 15 plus 3% will come to 5 lakh 30,450, and you keep on adding 3% in each of these years. And if you keep on doing that till the end of year 9, that is start of year 10, you will keep on getting the values. Now the question is, there is a purchase option. The question very clearly tells you that the purchase option is, EFG is reasonably certain to exercise the purchase option. So what do you guys think? Will the payment under purchase option be included? Well, yes, sir. What is the payment under purchase option? 30 lakhs. And as a result, at the end, you go to see at the end of year 10, the purchase option is exercised, in which case 30 lakhs is also taken. Now, if you sit and find the present value, like discounting factor is given as 9.04%, comes to on 49 lakh 99,000, you can approximately take 50 lakhs as well. So initially your right of use asset and your lease liability will be recorded, for example, at 50 lakhs. Now the question says you need to calculate the ROU asset and lease liability at each year. Now the question is, ROU asset 50 lakhs will be depreciated over how many years? What do you guys think? Well, the general thought is people end up saying 10 years because that is a lease term. However, I had said that whenever there is a purchase option and this purchase option is likely to be exercised, in which case the asset is going to stay with you for the entire 40 years, and hence 50 lakhs divided by 40 and 1,25,000 will be your appropriate depreciation amount. So 50 minus 1.25, 48.75, 47.5, karte, you will reach around 37.5 at the end of year 10. Sir, but after year 10, once the purchase option is exercised, well, whatever is a liability, you will pay that off. Lease liability account debit to bank. your asset will still be at 37.5, but now it will no longer be your ROU asset, it will be your owned asset, and hence there will be an entry at the end of year 10 that is asset account debit to ROU asset. So you will remove the right of use and you will say this is an owned asset. So 37.5 pip, which was your right of use asset, it will now become, let us say, your owned asset. So asset account debit, let us say, to the right of use asset you will get. Next, you come to the lease liability. When you look at the lease liability, remember, whenever the payments are made at the beginning, you will take the opening balance, from that deduct the payment and then calculate the interest. Sir, how does it matter? Well, it will matter, because if payments are made at the end, your opening liability ke upar interest will be levied and then payment will be done. But if the payment is made at the beginning, like 50 lakhs is the amount at the beginning, from this you will first subtract 5 lakhs. So your outstanding will be 45 lakhs adjusted opening, and on that 45 lakhs there will be a 9.04%, will give you 49 lakhs 6,800. This will become the opening for the next period, on which 3 lakh 15 will be, let us say, paid, and hence 45 lakh 91, on which you will again calculate, and this will keep on going till the end of year 10, where you will land up with 30 lakhs. Remember, you have to pay 30 lakhs based on your estimate. You have to pay 30 lakhs. So you have to pay 30 lakhs, and hence at the end of year 10, when the purchase option is actually exercised, you will say lease liability account debit, which is at 30 lakhs, to bank 30 lakhs, and then whatever is the asset which is at 37.5 lakhs on your right of use, you will make it as your owned asset. Okay, so this is a good question because it has purchase option, it has payments at the beginning, it has lease incentive, it has quite a few things. So it is a fairly good question, I would say. Now there are a few other questions which are pertaining to lessor accounting, sale and lease back, lease modification, lease remeasurement, which we are yet to do. But there are a few other questions also that we can possibly try. Go to question number 49. X, who is the lessee, entered into a lease agreement with Y, who is the lessor, to lease an entire floor of a shopping mall for a period of 9 years. So maybe the identified asset is the floor of the shopping mall and the lease term is 9 years. The annual rent is 70,000. To carry out the operation smoothly, X simultaneously also entered into another agreement, which is called as a facilities agreement, with Y for the use of certain other facilities owned by Y, such as passenger lifts, DGs, generator sets, power supply infrastructure, parking space, etc. Remember, these are not exclusively going to be used by us. In a mall, the developer makes all of this, and hence in a mall there are all of these facilities. So for these facilities I'm going to pay as well, for which I'm going to get my benefits. My customers will get spaces to park, my customers can use the lift, there will be power backup, etc., which are specifically mentioned for the annual service charges amounting to 1 lakh. As per the agreement, the ownership of these facilities shall remain with Y. Lessee's incremental borrowing rate is 10%. Facilities agreement states that will be coexistent and coterminous with the lease agreement. That is, till the time the lease agreement continues, the facilities agreement will also continue. When it terminates, the facilities agreement will also be terminated. The facilities agreement will be terminated automatically on termination of the lease agreement. X has assessed the standalone price of the lease agreement is 1 lakh 20. As per agreement, we are paying 70, but standalone price is 1 lakh 20. And standalone price of the facilities, like if I go to a mall, I'm going to pay for the facilities more. If I go to a regular place where I have similar area where I don't have these facilities, I might be paying 1 lakh 20. But with all of these facilities like power backup, lift, parking space, I am going to pay more. So for the facilities, I'm going to pay 80,000. X has not elected to apply the shortcut in 116 to not separate the non-lease components, and accordingly it separates the non-lease components. So basically it has not taken the shortcut, so it will separate the non-lease components. How will X account for the lease liability at the commencement date? So here there are multiple components. One is a lease component, that is a first floor identified asset. Second is the facilities. Over here I don't get substantially all the facilities on the right to direct use. Lift can be used by anyone, power backup will be available for anyone, and hence facilities give me benefit, though they cannot be linked to an identified asset. So facilities will be a non-lease component. The first floor will be taken as a lease component. Facilities give me benefit, however they will be non-lease. Now all said and done, you are agreeing to pay how much? 70,000 and 1 lakh, so you are agreeing to pay 1 lakh 70. Now that 1 lakh 70, how much of it is attributable to the first floor? Maybe that is 1,20,000 out of 2 lakhs. So 2 lakhs is the total standalone price. So we'll say out of the 1,70,000 into 120 upon 2 lakhs is attributable to the floor, as well as 1,70,000. Sir, how do you get 1,70,000? What I have highlighted in blue, this is the agreed amount I have to pay. All said and done, no matter what they say, I have to pay 1,70,000. It is coexistent coterminous. Total I have to pay 1,70,000. Out of this 1,70,000, I can say a part of it is attributable to the floor, a part of this is attributable to the facilities. So this is 80 divided by 200. So 1,70,000 into, let us say, 120 divided by 200 comes to, let us say, 1,02,000. So I need to find the lease liability. Lease liability is the present value of the lease payment. Non-lease payment, maybe 68,000 is attributed to the facilities. You will record it in the P&L as and when the facilities are utilized in each of the years. Lease liability and ROU asset you will create only for the lease components, which is 1,02,000. So if I want to find the lease liability, this is 1,02,000 into the present value annuity factor at the rate of 10%, which is the discount factor for 9 years. If I do this working, this is 1 divided by whatever this number comes. I don't know, maybe this is 5.759, 5.759 and 1,02,000, around 5,87,000 and something, accepted for a certain degree of rounding off, will be your lease liability. So when you look at these workings, this will be 1,02,000 ka lease payment in each of these 9 years. Sir, if nothing is given, well, we'll assume payment at the end, but here I think they've clearly told you somewhere that the payment is at the end. Otherwise, we will assume it is end if there are no hints given, and that is around 5,87,000. Sir, what about that 68,000? Well, they will be recorded in the P&L in each of their as and when those facilities have been utilized. Okay, next you go to question number 50. This is pertaining to foreign exchange. So we look at the forex part. Entity X is an Indian entity whose functional currency is a rupee. It has taken a plant on lease from Y for 5 years to use it and pay annual rentals in arrears. Very clearly told in arrears, which means at the end of USD 10,000 every year. On the commencement date, the exchange rate was rupees 68. So that is the spot rate at the commencement date. And the average rate for year 1 was 69. And at the end of year 1, closing rate was 60. It was 70. The incremental borrowing rate of entity X on commencement of the lease was 5%. This is the incremental borrowing rate which is given for a USD borrowing. Remember, you will take the dollar cash flows and you will discount it at the dollar rate, which is 5%. How will entity X measure the right of use asset and lease liability initially as well as the end of year 1? See, you will calculate initially as a present value of the future lease payment, which is $10,000 into, let us say, the PVAF at the rate of 5%, which is the dollar rate, for a period of 5 years, which means this will come to, let us say, around 4.3295. So 43,295 will be your initial right of use asset and your initial lease liability. This will be the amount that you will recognize initially. So, but this is in dollars. Your functional currency is in rupees. So you'll have to convert this at the exchange rate prevailing as on the date of transaction. 43,295 into, let us say, 68 comes to around 29,44,060. This will be the amount at which your lease liability as well as the ROU asset will initially be recorded. Perfect. Now the ROU asset will be further depreciated for a period of 5 years. So divided by 5, and 5,88,812 will be the depreciation. Will I need to remeasure the ROU asset? No. It is a non-monetary item. At the end of year 1, I cannot say that the benefits I can quantify clearly in monetary value terms, and hence it's a non-monetary item. But for lease liability, I can exactly quantify in monetary terms that for the next 3 or 4 years, I have to pay $10,000 each. So this amount, ROU asset, is non-monetary and will be shown at the historical rate. Exchange rate fluctuations will not impact it, and hence 5,88,812 will be the depreciation simply divided by 5. The problem arises in the lease liability working, where I will say my lease liability will first be determined in dollars. Remember, my true monetary liability is in dollar. So I will determine the lease liability in dollars, which initially, for example, is 43,295. On 43,295, there will be interest at the rate of 5%, which will come to 2,165 approximately. This is interest for 1 year, and there will be a payment of $10,000. So your closing comes to 35,460. Now each of these numbers you will convert. Well, opening will convert at the opening rate, which is 68. Interest will convert at the average rate, which is 69. Payment is happening at the end, so will convert at the closing rate, that is 70. And because lease liability is a monetary liability, this 35,460 will also be converted to the closing rate. So if I take these numbers, 68 for opening, 69 for interest, 70 for the payment, and closing is at 70 also, then my number is not tallying, because 2944 plus 1,49,000 minus 1 lakh will come to 23,93,445, but as per Ind AS 21 this comes to 24,82,200. So the difference over here, this 88,755, this increases the liability, so will credit the liability. Sir, but why is it increasing? Because of different exchange rates used, and hence you will credit the liability. What will I debit? If I credit the liability, something has to be debited. Well, because this is arising on foreign exchange, this is forex loss which will be taken to the profit and loss account. So this is, let us say, forex loss which will be taken to the profit and loss account. Forex loss going in the profit and loss account. Okay, so this kind of reviews regarding foreign exchange. Then there are a few other cases as well which is linked to Lessor Accounting, modification, etc., which we will do. Now question 61 is like a very good question. It is from the November 23 paper, and this question kind of takes care about a lot. So if you have read this, great, otherwise better if you just read this separately, but it is a very good question, and if I have to revise whatever has been done, this is one question where I can do that revision. It will have in substance fixed lease payment, variable lease payments, it will have, let us say, things like separation of lease and non-lease component, a lot of interesting things that are there. So what is to be done? So there's a big case if you read, and then they are asking you analyze the above and identify the lease components and non-lease components. Okay, so that is easy. You'll have to identify lease and non-lease components at the commencement date, compute and allocate the consideration to the lease and the non-lease component. Well, you will allocate it in the ratio of standalone price. So when you're reading the question, you will first figure out what is the lease component, what is the non-lease component, and then allocate in the ratio of the standalone prices. Compute the lease liability, which is the present value factor at the rate of 10%, is 2.49 for 3 years, may be adopted. Compute the lease liability, where the present value factor at the rate of 10%, that is 2.49 for 3 years, may be adopted. Determine the recognition and treatment of the lease component and non-lease component. So here accounting is also to be seen. So first we have to figure out the lease and non-lease component, allocate the transaction price to the lease and non-lease component, find the liability, which is the present value of the lease component. Like in that first floor and facilities, we found 1,02,000 was towards the lease. Find the present value of the lease component and then show the accounting entirely. Okay, so if I review this, a consumer products entity, that is entity A, enters into a lease agreement with entity B. Again, a consumer products entity, that is entity A, enters into a lease agreement with entity B for a dedicated production line to manufacture one of its store branded household products for a period of 3 years. So maybe you are a consumer product company like a Hindustan Unilever or some Colgate, for example, and you are entering into an agreement with entity B who has a production line to manufacture its products. Let's say you look at a lot of these big companies, they will say marketed by Colgate or Hindustan Unilever, but manufactured by someone like a job work basis. Entity A, so this is a dedicated production line. Entity A has agreed to order a minimum of 1 lakh units per month and to make a payment to entity B as per the following agreed rate. So there is a in substance fixed payment, because minimum 1 lakh ke liye payment will have to be made. That is 240 per unit if the ordered quantity is between 1 lakh to 1 lakh 20, 246 if the ordered quantity is between 1 lakh 20 to 1 lakh 50. I'm saying that even if nothing is there, my minimum in substance fixed lease payment will be 1 lakh. If I were to take this in lakhs, 1 lakh into 240 per unit, can I say 240 lakhs per month will be my in substance fixed lease payment. Sir, anything above this, well, that is variable, and that is a variable lease payment linked to rate or index. No, it is a variable payment linked to more products purchased, and hence it will be go to the PNL as and when the actual quantity is purchased. But if initially you have to determine the lease liability, that has to be based on the lease payment. Now one can say that okay, that means 240 is the in substance fixed payment? Yes, but is it entirely for the lease? That is for the production line? No. When I pay 240, I get the right on that production line which is used, but at the same time I also get those products, and hence a part of this 240 is for the products, a part of this for the production line. So what is entity B? That is the job worker. They are saying that I will set up a production line and that line will work as per your requirements and I will give you products. For that total arrangement, I'm going to charge you, let us say, for minimum 1 lakh units, I'm going to charge you 240. So when I pay 240, I'm getting access to those 1 lakh units. I'm also getting access to that production line. Let us read it further. As per the terms of the agreement, A has the exclusive right to use the production line. A is the lessee, has the exclusive right to use the production line. Entity B cannot use the specified line for any other customer. The type of household product is specified in the contract. A issues instructions to B about the quantity and the timing of the products to be delivered. If the production line is not producing the household products of A, it remains idle. That means I am getting the right to control direct usage of the identified asset, that is the production line. B operates and maintains the production line on a daily basis. A has estimated that for manufacturing each unit, B incurs an average cost of 195. So if, let us say, A would have said that I don't need you to buy the production line, I will give you my production line, you come and manufacture, they will still charge you at least 195. Practically it is 195 plus profit, but 195 is the variable cost for the products itself. Further, the observable standalone price for the rent of the production line is 60 lakhs per month. So these two will help you in allocating for the products. For every product, even if we were to provide the production line, they will still charge me 195 for the product. So that is for the non-lease component, that is for the product. Let us say products we have, if someone just wanted the production line, then the standalone rent for the production line is 60 lakhs. Are we paying just 60 lakhs? No, we are paying 240 lakhs, but 240 lakhs pay karke, we are not just getting the production line, we are getting the right to use the production line as well as the product. So it is a composite payment for both of them. Entity A's incremental borrowing rate at the commencement date is around 10%. That is fine. Entity A concludes that the arrangement contains a lease. Great. So they have told you this. In my opinion, even if it was not told, you could have clearly inferred that there is an identified asset, that is a dedicated production line, which is physically distinct. Supplier cannot substitute it. So there is a identified asset. All benefits from the production line are coming to A only. So substantially all benefits go to A, and that when the line is used, how it is used to be used, instructions, all of these are given by A. And as a result, one can say that there is clearly a lease. In this question, they tell you directly. It also elects not to apply the practical expedient, that is shortcut in 116 of not separating the non-lease component from the lease component. So it decides not to take the shortcut, which means it will separate. Accordingly, it separates the lease and the non-lease components. So this is this entire case. Analyze and identify the lease and the non-lease component. Can I say that the lease component will be the right to use the production line, that is my lease component, and my non-lease component will be the products, the job work, for example, that I'm getting. I'm getting a benefit, goods or services, that is a non-lease component. Compute and allocate the consideration into the lease and the non-lease component. So if I were to go to see the first line, production line is the lease component, job work is a non-lease component. As per agreement, nothing is paid for the production line as per agreement, and we have said that minimum 240 per unit into 1 lakh units, so 2 crore 40 has to be paid apparently for the products. However, if it was just products, then they would have given me at 195 also. There's no profit margin given us, so we have ignored it. So 195 into 1 lakh, 1 crore 95 should be the standalone price if it was just the products and I had not made the other entity also take the production line. Or if it was just the production line and there was no products or job work that they had to do, then they would have charged me 60 lakhs, which means over here 2 crore 40, which is the in substance fixed payment, not fixed lease payment. It is not just for the lease. A part of it is for lease, part of it is a non-lease. So if I look at, let us say, the value over here, this is 2 crore 40, and I will allocate the 2 crore 40 or 240 in the ratio of the standalone prices, that is 60 upon 255 for the lease component and 2 crore 40 or 240 lakhs into, let us say, 195 upon 255 for the non-lease component, and as a result this is 56,000 47 56 lakh 47,059 towards the lease component, and 1 crore 83 52,941 towards the non-lease component. So they have said that you first identify the lease and the non-lease component. The lease component is the right to use the production line. The non-lease component is, let us say, getting 1 lakh units of a product. Then allocation, we will say in the ratio of standalone prices, there's an in substance fixed payment of 240, but that is in substance fixed payment for lease and non-lease component. You allocate it in the ratio of the standalone prices and you get around 56 point something lakhs towards the lease component, 183 point something towards the non-lease component. Compute the lease liability. Now ideally, if I go to see lease liability is the present value of the lease payments, which is around 56 lakh 47,059. This is a monthly payment into the present value monthly factor for the next 36 months. Sir, why? If you go to see, they have told you that the lease is for a period of 3 years. Now, if it is for a period of 3 years, every month you have to, effectively you are saying that I am going to pay effectively around 56 lakh and something for the lease component. So, into the present value monthly factor at the rate of 36 months, ideally should be taken. Ideally. Now, if you see the question, what does they tell? They tell you the present value factor at the rate of 10% per annum is 2.49 for 3 years, may be adopted. They've clearly told you to adopt the annual factor, and hence there is a approximation which is in a way wrong. So, you're taking 56 lakh 47,059. This is per month into 12 months. If I do 56 47 059 into 12, if I do, this is around 6 crore 77 lakh 64,708 into the PVAF of 2.49. This is the annual. Ideally, time value wise, this is not correct, but the question has clearly told you to take the 9% factor, 10% factor on an annual basis. So into 2.49, if I do, this is 1 crore 68 lakh 73,413. This will be taken. I've taken this as a reference note that by ideally payments are made monthly, lease liability should be calculated taking the monthly factor. But the questions very clearly told you to take based on annual. So you find the annual payment multiplied by the annuity factor and get around 16 crore 87 lakh 34,123 around. Okay, so this will take your value, determine the recognition of the lease component and non-lease component. See, lease component, you will recognize the lease liability at this particular value and ROU asset as well. So you will depreciate this over the remaining 3 years and you will recognize interest and the payments. Non-lease component, as and when it happens, around 1 crore 83 52 941 each month will be taken to the profit and loss account. So lease component would be recorded by creating a lease liability and a corresponding ROU asset of around 16.87 crores. Subsequently, ROU asset will be depreciated over the next 3 years. Lease liability will be adjusted taking interest rate of 10% and lease payment in each year. Remember, this is taking annual and hence we will take it each year. The job work charges would be recorded at around 1 crore 83 in the profit and loss in each month. So this is for the non-lease component. So this kind of takes care of your question number 61, which I would reckon is a fairly good question from your overall exam perspective. Let me just see if there is something else we want to touch upon. We can actually touch upon question number 56 as well. It is more of identified asset, right of use, etc. It's a fairly long question, but if I look at each of these are 3 or 4 different scenarios. Each of these scenarios will be tackled here. Okay, so question number 56, which is probably one of the last questions from this section. The last mile is a dedicated cable that connects Y's network and the end customer's device. So there's a dedicated cable. It's a dedicated cable, clearly told. The use of this cable is at the discretion of the customer. So customer can decide when to use, how to use, etc. Y decides the location of endpoints and has a right to replace these lines. However, it is not practical to replace these lines. So supplier has the theoretical right to substitute, but it is not substantive. Since replacement would require additional cost without any corresponding benefit. Whether arrangement will be the scope of 116? Yes, because there's a dedicated cable, which means it is a physically distinct item. So there's a dedicated cable where supplier does not have a substantive substitution rights. There can be a right to substitute, but that is not substantive. In substance, it will not be substituted. So there's an identified asset, and the cable will be used at the discretion of the customer, and hence this will be we can say this can be, for example, a substantive substitution right not being available, right to control use going to the customer. So there is a lease. Scenario 2, if it is practicable for Y to replace the lines, and Y would actually benefit from this replacement, would your answer be different? Well, yes. In such a case, there will be no lease. Why? Because if the supplier, that is Y, can substitute, we can say that means there is no identified asset, in which case there will be no lease. Achha, this is case 1. Then you go to case 2. Customer X enters into a 10-year contract with a utility company Y for the right to use 3 specified physically distinct fibers within a larger cable connecting Mumbai to Delhi. So it's like a big cable is like a big building, and every fiber is like a separate flat. So over here there are physically distinct 3 fibers, like 3 different flats. Customer makes decisions about the use. Customer makes decisions about the use of the fiber by connecting each end of the fiber to the electronic equipment. Y owns the extra fibers but can substitute those for the customer's fibers only for reasons of repairs or maintenance or malfunction. The useful life of the fiber is 15 years, whether this arrangement is covered under Ind AS 116. So over here what is happening is Y has some extra fibers, and they can substitute only for repair and maintenance. So I have to first see whether there's a physically distinct fiber. Yes, 3 physically distinct. Can Y substitute it? Answer is no. They can only substitute for repair, maintenance or malfunction. Otherwise, they do not have the right to substitute, which means there's an identified asset. Customer makes the decisions on how the fiber will be used, etc. So over here, customer makes the decisions about the use of the fibers, and hence one can say over here that there is a right to control use with the customer. So would this arrangement be covered by 116? Yes, it will be covered. Why? Because there is a physically distinct 3 fibers which the supplier cannot substitute, and the decision on how to use the fiber, etc., all of this will be taken by the customers. Achha, customer X enters into a 10-year contract with entity Y for the right to use a specified amount of capacity within a cable connecting Mumbai to Delhi. The specified amount is equivalent to customer having the right of use of full capacity of 3 fiber strands within the cable. This is slightly different. Remember, over here we have not taken 3 physically distinct cables. We have said that, let's say if your fiber has 30 cables, I want to use 10% of the capacity. Which 10%? It can be anything. Now that 10% is equivalent to probably capacity of 3 cables, but I have not physically identified. It is like saying that if in a new society, when you look at, let us say, a car parking space, there are dedicated earmarked spaces. But in an old society, you can park whenever you want. If you can park wherever you want, there is no physically distinct asset. So over here, the specified amount is equal to customer having the full capacity of 3 fiber strands within the cable. The cable contains multiple fibers with similar capacities. Entity Y makes decisions about the transmission of the data. That is, Y lights the fibers, makes decision about which fibers are used. So it is Y. Y is a supplier. If you read the question properly over here, Y is a supplier. Supplier is making those decisions. The useful life is 15 years. Whether this arrangement is covered by 116, answer is no. Why? Because there is no physically distinct fiber where you are getting a right of use. Further, the decisions on which fiber to be used, all of those decisions are taken by the supplier, that is the lessor, and hence it is not covered by Ind AS 116. So there are all of these various cases which kind of help you in a relatively decent understanding of the topics which are done till here. Further, if you go, there is Lessor Accounting, but before you go to Lessor Accounting and special cases, you can actually go into certain cases of lease modification and lease remeasurement, which is also, we are trying to wrap up everything for the lessee, and then lessor and other special cases we can do separately. Okay, so this is on lease modification or lease remeasurement from the lessee's perspective. Okay, so we'll go on into the part pertaining to the lease modification as well as lease remeasurement. Okay, so these sound to be fairly similar terms, but they are not at all similar. First, you have something what is the lease remeasurement. What do you mean by lease remeasurement? It kind of means that there is no renegotiation between the lessor and the lessee. However, there are certain things like, for example, you thought renewal option will not be taken. Now you think renewal option will be taken, or you thought, let us say, there will be no purchase option exercised. Now you think purchase option will be exercised, or you thought that variable lease payment which were linked to a rate or index, and those rates or index will change. Now in these particular cases, don't you think that if these changes happen, your estimate of lease liability will change? And if the estimate of lease liability will change, you'll have to do certain adjustments. So for these remeasurements, I'll again repeat, remeasurements are changes which are not an outcome of renegotiation. That is, you originally also had 5 years non-cancelable plus, let us say, a renewal option for another 5 years. You earlier thought that I will not exercise the renewal option. 2-3 years have gone by. Now you think I will exercise the renewal option, in which case you are trying to remeasure. You are trying to remeasure taking this fact into consideration. If I were to take this fact into consideration, what would be my revised lease liability is something that I'm looking for. So when I look at lease remeasurement, remeasurement in the AS as identified will be due to 5 factors. It can be due to a possible change in the reassessment of lease term. This may be due to renewal or termination option, as a case may be. Reassessment of the purchase option, whether to be exercised or not to be exercised. So when I'm looking at, just a second, there is factor 1, the reassessment of lease term. The example that we discussed initially, earlier we thought 5 years, 2 years have gone by, 3 years are remaining. Now you think we'll also renew it for another 5 years. So your revised remaining lease term will be 3 plus 5, that is 8 years. And if it is 8 years, you'll have to find the revised lease liability, and we'll have to figure out where the adjustment will go. Or a reassessment of purchase option. You thought that purchase option will not be exercised. Now you think we will exercise the purchase option, in which case there will be again a change in the lease liability. Well, if these two are the only, one of these two or both of them are the only changes, then for finding the revised lease liability, you will take the revised discount rate at the date of modification. So you will take the revised discount rate at the remeasurement date. Sir, present value, the remaining maybe 8 years of lease payment discounted at the rate prevailing on the date of remeasurement is what you will take. However, if there are a few other reasons why, the other reasons may be a change in the estimate of residual value guarantee, or change in the variable lease payment, or now there are certain lease payments which now become in substance fixed. So factor 2, these are factor 2, in substance fixed lease payments are happening, or future payments which are changing due to rate or index, or expected amount under residual value guarantee. Here you will take the present value, the revised lease payments, yes, but you will continue with the original discount rate. The standard has not given you any rationale or logic for this. However, if it comes, this is something that you have to be clearly aware of, that when you are taking a remeasurement, what is a remeasurement? Arise due to changes in lease measurement other than lease modification. That is, you are not going to the lessor and doing a renegotiation. What was there in your agreement is the same facts, same things that continue to remain. It is just that you are changing your possibility of a let us say payment. So if the remeasurement is due to some changes in factor 1, you will take the revised discount rate. If there are changes due to factor 2, you will take the original discount rate. But what if it is due to both? Like, you will see a sum where the lease term is also reassessed, and your variable rate linked to variable payment linked to rate or index is also reassessed. In which case, what will we do? Well, sir, in such a case, you will take the revised discount rate. Remember, if there is even one change which arises due to the revised discount rate, you will take the revised discount rate. If only factor 2 changes happen, then you take the original rate. In all other cases, you will take the revised rate. And this is where a student kind of gets confused. We will take the revised rate. So what are the steps? So there are 3 steps that you will follow over here. First is try to find the carrying value of the lease liability on the remeasurement date. This must be the value based on the existing terms, existing values. Second, you will find a revised liability, that is a present value, the revised cash flows at the remeasurement date. Now this present value can be calculated based on the revised rate if it is due to a factor 1 change, due to original rate if it is due to a factor 2 change. If it is a combination of factor 1 and factor 2, then it will be a combination of these values. Just a second please. We will find these differences and I'll do it with a question set only, so it is easier for you to understand. And the difference between 1 and 2, what will you do? You will adjust the liability. Okay, so if the amount is increasing, you will credit the liability. Sir, what will you debit? Well, should I debit the loss? Answer is no. Well, if the liability increases, usually along with the liability you get more right of use. You are getting it for 8 years, or you are getting a purchase option, which means you are getting ownership, or it becomes the existing right of use become more or less costly, like due to residual value guarantee or future lease payment, you are getting the same right of use, but it is now becoming more costly. So the only difference I can foresee between a factor 1 and factor 2 change is in factor 1 changes, you are actually getting more or less right of use, maybe for more years or for less years. In factor 2 changes, you are having almost the same right of use, but that is becoming more costly because the variable payment is changing, or maybe the residual value guarantee estimate is changing. With the corresponding effect will go in the ROU asset. This will not be adjusted against the lease. This will not be adjusted against the P&L account. So over here, before you go to, let us say, modification or something, I would want to do a few problems pertaining to lease remeasurement. Then go to lease modification and do a problems pertaining to lease modification, do this summary, and then kind of wrap up the section pertaining to the lessee. So if I were to review the questions on this, let us say if I were to go to question number I don't know, where is this question? 55, no, 54, 53, I forgot where this question was. Yes, you have question number 58. Let us review this, and you have to tell me which rate or how should you do the workings. The company has entered into a lease agreement for its retail store on 1st of April 2011 for a period of 10 years. The lease rental is 56,000 per annum and is payable in arrears. Very clearly told that this is payable at the end in arrears. The company recognized a lease liability of 3,51,613 at inception using an incremental borrowing rate of 9.5% as at 1st April 11. Now they have given this to you directly, so you don't need to do, but even if they were not given you, then on 1st of April 11, you will take 56,000 into the PVAF at the rate of 9.5% for a period of 10 years. If you do this working, you will get exactly 3,51,613. This is already calculated. As per the terms of the lease agreement, the lease rental should be adjusted every 2 years to give effect to the inflation. So this is a reset which is happening due to inflation. Inflation cost index as notified by the income tax department shall be used to derive those lease payments. So like in income tax capital gains, you take those numbers that will be taken for the purpose of this calculation. Inflation cost index was around 280 for the year 11-12 and 301 for the year 13-14. The current incremental borrowing rate is around 8%. Vapas, inflation cost index was 280 for the year 11-12 and 301 for the year 13-14, and the current incremental borrowing rate is around 8%. Show the journal entry at the beginning of year 3 to account for the change in the lease. So in this particular case, what is happening? In this particular case, we will have, let us say, at year 0, you have another 10 years and your lease liability is around 3,51,613. But after 2 years, there is a change. What is happening? Well, your CPI index is changing. So from year 2 on, or let us say from at the end of year 2, you will reset the future lease payments at 56,000 into 301 upon, let us say, 280, which is 56,000 into 301 divided by 280 will come to around 60,200. So your payment, let us say, comes to around 60,200. Okay. Now this is for the remaining 8 years. You can find your revised lease liability. The steps over here is to first calculate your lease liability as per books of accounts. Your lease liability will be 3,51,000. If I were to make an amortization table, 3,51,613 on this 9.5% interest less rent paid is 56,000 gives you closing. Again, 9.5% interest minus 56,000 comes to 3,04,273. This is your existing carrying value. Now, as per the revised terms, your payment is 60,200 into the PVAF. Now, this comes a problem. You will discount at what rate? Now, there are two rates. One is the original rate of 9.5%. You guys tell me which rate should you discount. One is the original rate of 9.5%. One is the revised rate of, let us say, 8%. Which is the rate that we should use for the purpose of discounting? Well, is there a renegotiation that you have done? No. The CPI reset was already agreed. So, it is a lease remeasurement. Now, this lease remeasurement will be at which rate? Well, if there's a change in lease term, which there is no, or purchase option, which there is no, then you will take the revised rate, that is 8%. But for other reasons like variable lease payments, residual value guarantee, etc., you will take the original rate. And the original rate over here is perfect, it is 9.5%. And hence, you will take, let us say, 9.5% only for the remaining 8 years, which will give you a particular amount, which is around, what do you say, maybe 3,27,092. Now, in your ledger, your liability is appearing at 3,04,000. It is now 3,27,000, which means you will increase the liability by around 22,000. You will increase the liability by 22,819. So, your liability will go up by 22,819. So, liability is credited. What will you debit? It's a right of use. Your ROU will become more costlier. You thought that your right of use is costing you a particular amount. No, it will cost you slightly more. So, over here, this is debited against the right of use asset and a corresponding lease liability. So, this is regarding your lease remeasurement, and you continue with the original rate. An important thing is, as this is a remeasurement, merely due to change in variable lease payments linked to index, we should take the original discount rate, that is 9.5%. Okay, a much more important and interesting question will be question number 43. S49, 149 means we have a super 149 file. These are super 149 questions where I've written S149. Otherwise, we are trying to discussing almost all of the LDR questions. Entity W entered into a contract for lease of a retail store with entity J on 1st of January 2011. Okay, so this is entered. The initial term of the lease is 5 years with the renewal option for a further 3 years. So this is 5 plus a possible 3 years. The annual payments for the initial term and the renewal term were 1 lakh and 1,10,000 respectively. So for the initial 5 years, it was 1 lakh, and for the remaining 3 years, it was around 1,10,000 respectively. The annual lease payment will increase based on the annual increase in CPI. The annual lease payment will increase based on the annual increase in CPI at the end of the preceding year. So every year what the payment is there will increase based on the CPI of the earlier years. For example, this is important sentence. For example, the payment due on 1st January 12 will be based on the CPI available on 31st December 11. Payment due on 1st January 12. So in this case, the institute has still remained silent. This has also come in an exam where also the same case has been there. So the question does not tell you that this 1 lakh or 1,10,000 is paid at the beginning or at the end. Earlier, other sums told you that the payment is in arrears or in advance. This question remains silent. However, it tells you, for example, the payment due on 1st January 12 will be made based on the CPI on blah blah blah. But the payment due on 1st January 12, you guys tell me. That means this hint tells you that the payment is at the beginning because the lease commencement is at 1st January, or payment is at the end. What do you guys think? It will be at the start. That is what the institute has also assumed, and that is considering this example that the payment due on 1st January 12 will be based on something. So that means if one of the payments is due on 1st of January, the other payments are also due on 1st of January. That means payments are at the start. In this case, if you assume at the end, I don't think that the institute will give you credit, because in the study material and also in the exam question, they have not taken that. They have taken payments at the beginning, considering this possible hint. Okay, so there is a hint over here. Entity W's incremental borrowing rate at lease inception and on 1st of January 14 is 5% and 6% respectively. So at lease inception, so this is at the beginning, the rate is 5% and then it is 6%. And CPI at lease commencement date and as at 1st of January 2014 is 120 and 125 respectively. Okay. So this is your CPIs also changing. Now, ideally, I would love to have CPIs at each date. Let's say for the first year, second year, third year, but they have only given me CPI at the commencement date and then directly CPI on 1st of January 14. Now, ideally, I need the CPI on 31st December 2013. to adjust my payment on 1st of January 14, but for all practical purposes you can say that the CPI on 31st December 2013, that is just a day before, will be the same as the CPI on 1st of January 14, a day later. At the lease commencement, W did not have a significant economic incentive to exercise the renewal option, which means your original lease term would be 5 years only, because there was no significant economic incentive to exercise the option. In the first quarter of 2014, W installed unique leasehold improvements into the retail store and estimated the 5-year with an estimated 5-year economic life. W determined that it will only recover the cost of these improvements if it exercises the renewal option, creating a significant economic incentive to extend. So on 1st of January 2014, what is happening? Maybe these are done in the first quarter, but Institute has said that this effect will be taken from the start of the quarter, that is on 1st of January 14. You are now expecting to exercise the renewal period. At the same time, on 1st of January 14, there is a CPI reset happening. So are either of these new things that you are sitting and renegotiating with the landlord? No. These were already there in the agreement. Now you are kind of considering them separately. Is entity W required to remeasure the lease in the first quarter of 2014? Do I need to remeasure? The answer is yes. Sir, what are the steps? Step number 1 is to find the carrying value of the lease liability at, let us say, the date of modification, that is on 1st of January 2014. Now what happens is, you will find the initial lease term. Initial lease term is 5 years. Initial lease payment is 5 lakh. Well, let's say if I were to take the CPI, this is 120 upon 120, and hence this comes to 5 lakhs only. Sure, initial payment is, for example, 5 lakhs, and you try to find the present value annuity factor. Now you can even make a table, but otherwise this is 5 lakhs into the PVAF at the rate of, initially I think the rate was 5% for a period. I think the battery is low. Sir, our battery is also low. Just a second. So this is 5% for, let us say, a period of how many years? It is 5 years, but from year 0 to 4. Remember, your lease payment can be from year 1 to 5. In this case, it is from years 0 to 4. So over here, just a second, please. Yes, so this is year 0 to 4, and if I do the workings, I will get around 4.5459, and hence my initial lease liability will be, this is not 5 lakh, sorry, this is 1 lakh. My initial lease liability will be 4,54,590. Now because the payment is made at the beginning, I will say 4,54,590 minus the payment gets an adjusting opening balance, and on that I will charge interest at the rate of 5%, gets closing, again goes to the second year, less 1 lakh gets an adjusted opening and then closing, and then at the third year. So when I do this, you are at 31st December 2013. Now on 1st of January 14, two changes are happening. So I found the carrying value. Now on 1st of January 2014, two changes are happening. First, CPI is getting reset, like we did in an earlier problem, and if CPI is getting reset, then we will consider let's say the original rate. But along with the CPI getting reset, your renewal term is also, estimate is changing. You still have 2 years remaining, but now you assume that 2 plus renewal option will be taken, that is 3 years. Which means when you sit to calculate the revised lease liability, there will be total 5 more payments, 5 more years. You will adjust the payments in line with CPI, but tell me, the discount rate you will take is what rate? Will you be taking the original rate over here as well, that is 5%? Or will you take the revised rate, that is 1st January 14, that is 6%? Which one will you take? 6%. What is the reason over here? It is because there is also a renewal option. If let us say it was just a CPI reset, you would have taken 5%, but because there is a renewal option, you will have to take 6%. So you would find the revised lease payments. Sir, what is the revised lease payments? Well, it will be 1 lakh into 125 by 120, which will be 1,04,167, which is for the 4th year, which will be paid at the start of the 4th year immediately. Then for the 5th year, again 1 lakh into 125 upon 120, that is 104,167, that is for the 5th year, will be paid at the start of the 5th year. You are already at the start of the 4th year, and hence this payment is just 1 year away. So this is 0, this is 1. And let us say when you go to the next year, well, now the payment is 1 lakh 10, but the payment is 1 lakh 10 at the beginning. Now this is 1,10,000 at a CPI of 120. Now the CPI becomes 125. So this is 1,10,000 into 125 by 120 comes to 1,14,000, 1,14,000, 1,14,000 for the 3 years during the renewal period. This will be discounted at the 6%. This is the revised rate. Why? Because there is a change in the lease term as well, and hence you get around 4,91,346. This amount is your revised lease liability. Now your lease liability is 1,95,000. It has to go up to 4,91,000. So there's an increase of around 2,96,000. So you'll credit the lease liability by 2,96,000 with a corresponding debit going to the right of use asset. So it's a very good question, I would say, within the lease remeasurement section. This is the best question because there is a CPI reset also covered over here. There's a renewal also covered over here. The payments are at the beginning and that beginning has to be inferred. That is also covered over here. So it's a very good question, and without any surprises, this had even come in one of the earlier exams. So we will just stretch a little and we will try to also discuss regarding the lease modification. And once you kind of do the lease modification, the lessees section kind of gets done. So when we are looking at lease modification, what do you mean by modification as compared to remeasurement? In case of remeasurement, there is no change in the lease agreement. But in lease modification, the lessee goes to the lessor and he says, well, you know what, I want to make certain changes. Now these changes will be for what? Maybe the lessee wants more area or less area. So that is called as changes in scope. Earlier I had the first floor, now I also want the ground floor. That is changes in scope. Or the lessee just has the first floor, but the lessee now believes that they want to change the rent. COVID comes, I'm unable to pay, I want to change the rent. I can even change the lease payment if, let us say, the lessor agrees, or vice versa. Even lessor can come and say that I want to increase the lease payment, like what is happening in Bangalore or Bangalore. A lot of lease rentals are getting revised. Or change in tenure. Sir, but change in tenure is renewal option. No, there was no renewal option. It was a 5-year lease, 3 years have gone by, 2 years are remaining. I want to continue in this. So I go to the lessor and I tell that I want another 5 years. And that is a renegotiation that is happening. So when I look at a renegotiation, this is lease modification, refers to a renegotiation which was not earlier agreed. If it was earlier mentioned in the agreement and now your assessment is changing, that is a lease remeasurement. If it was not there in the lease and now you are bringing that into consideration, that is a lease modification. Are we clear with this? So when I'm looking at the lease modification from the lessee's point of view, there can be 3 broad areas. There can be changes in lease rent, increase or decrease. There can be changes in lease tenure, increase or decrease, or there can be change in lease scope. That is area, increase or decrease. So a modification is negotiated after the lease commencement and can be a change in consideration, that is rent, change in tenure, or change in scope like area. Now what do? The standard over here says that in case there is a modification which results in an additional scope, that is additional area, and that additional area is at the standalone price. Like for example, I have taken the first floor on rent for 1 lakh rupees a month. Now with the same landlord, I want to also take the ground floor. Now in the ground floor, the landlord is ready to give me at 90,000. Now rather than entering into a new agreement, I and the landlord have a good relationship, in which case rather than entering into a new agreement, I will modify the existing agreement, and in that existing agreement only, let us say I will showcase that there is an additional in the additional agreement, in the existing agreement itself, I will showcase that there is, let us say, instead of 1 lakh, 1,90,000, and instead of just first floor, I'm saying first and ground floor. So this is a modification whereby I'm increasing the area, and that increases at the standalone price. Now the ground floor standalone was at 90,000 only. Maybe we have got a bit of a concession because there was no broker involved, but otherwise 90,000 is a fair standalone price of the ground floor. In which case, Ind AS 116 says that it may be a modification of the existing lease. However, there's no reason why your existing lease liability for the first floor or your existing ROU asset for the first floor should be affected. This is as if it's a new lease which is entered, and as a result, if these two conditions, that is, there should be additional area, that is additional scope, and that additional area should be at the standalone price, in which case that additional component, that is 90,000, will be used for the purpose of calculating a separate lease liability, and a separate ROU asset for the ground floor will be created. Your existing lease liability and your existing ROU asset will not be disturbed. So over here we say if a modification is accounted as a separate lease, if there's an additional right of use, and that additional right of use is commensurate with the standalone selling price. However, if let us say there's no additional right of use, like for example the rent was 1 lakh, we don't want the ground floor, but we said this 1 lakh has to be reduced down to 80,000 because I don't have enough money to pay, and for whatever reason the landlord agrees, in which case there's no additional right of use, in which case I cannot say that there is going to be a separate lease for which a separate ROU asset, separate lease liability. G nahi. Your existing ROU asset and your existing lease liability is getting altered, and hence you have to do certain workings. So if there's a mere change in rent or a mere change in tenure or a mere change in scope which is not meeting these two conditions, then we treat it as a modification of the existing lease. That is, you will have to remeasure your existing lease liability. Steps are broadly the same. You will, step number 1, calculate the carrying value of your lease liability. Sir, how do I do that? I first find the carrying value of the lease liability at the commencement date, prepare the amortization table, come to the value at, let us say, the modification date, and then you compare it with, let us say, step number 2, which is finding the revised lease liability. You will find the revised lease liability, which is the present value of the revised payments over the revised tenure at the revised discount rate. In this case, there is no original or revised. Logically, if you are finding the revised lease liability, in my opinion, you should take at the revised rate only. But in the earlier remeasurement case, in certain cases, you had to take the original rate. In this case, you will take the revised lease liability at the revised cash flows over the revised term, discounted at the revised rate only, and the difference, if any, will be adjusted against the ROU asset. So in case the above conditions are satisfied, modification will be taken as a separate lease with a separate ROU asset and a separate lease liability. Lease accounting will not be altered for the existing first floor. However, in case one or both conditions are not satisfied, the accounting will be as follows in the books of the lessee. If they are not satisfied, the accounting will be as follows in the books of the lessee. Modification, there is no separate lease created. Now there were 6 permutations and combinations. What can happen? Well, rent can increase or decrease, tenure can increase or decrease, scope can increase or decrease. So on the left hand side, even over here, that we will take the increase in rent, increase in tenure, or the increase in scope, or even a decrease in rent. So on one side, we will say that the modification, if it does not meet those conditions, it can either change, that is either increase or decrease the consideration. It can increase the lease term or increase in scope, but this increase in scope is not at standalone selling price, and hence it is not a new lease. In this case, what will I do? Well, I will do the 3-step working, that is same as remeasurement. That is step number 1, find the carrying value of the lease liability. Step number 2, find the revised carrying value as the present value of the remaining payments. Step number 3, compare the two and take the difference against the ROU asset. It is going to be simple. Sir, but there are 2 other things. What are remaining? That is decrease in tenure or a decrease in scope. That is a decrease in tenure or a decrease in scope. Sir, over here what will happen? Well, you will have to do the 5-step working. Sir, what are the 2 additional steps? See, what is the difference between the thing on the left hand side and right hand side? On the left hand side, most of the places, when you increase the lease term, listen to this carefully, or when you increase the scope, it is as if you are acquiring additional right of use. If you are acquiring additional right of use, like if you are acquiring additional PP, at the time of purchase, you don't need to do any separate gain or loss calculation. You are acquiring additional right of use, additional tenure, you don't need to do a separate gain or loss calculation. However, on the right hand side, what is happening is you are decreasing the tenure. Like earlier, you are going to use the property for 10 years. Now you are going to use it for 5 years only. So you are in a way giving up 50% of your right of use. Or earlier, you are using 5,000 square feet of area. You are now using only 2,500 square feet of area. You are giving up 50% of the area. If you are giving up 50%, that is, if you are giving up, you guys tell me, when I buy a fixed asset, is there a gain or loss calculation? No. But when I sell a fixed asset, is there a gain or loss calculation? Yes. So over here, what I'm doing is, in the right hand side, I'm selling maybe a part, giving up a part of the right of use, and hence on the right hand side, I'll have to do 2 additional steps to find out the gain or loss on transferring of that right of use. That's about it. Sir, what about decrease in rent? Well, if the rent decreases, you are not giving up any right of use. You had 5,000 square feet of area for 10 years. You still have 5,000 square feet of area for 10 years. Maybe that existing right of use becomes less costly. However, for tenure as well as scope, if you are giving up some term of usage, if you are giving up some area, you are actually selling, that is giving up a right of use. And if you are giving up a right of use, apart from remeasuring the lease liability, apart from doing all the regular 3 steps, you have to do additional 2 steps, which are, you have to find the proportionate ROU asset as well. that what is the ROU asset. Like you find the lease liability carrying value, you also have to find the ROU asset carrying value, and then figure out an appropriate proportion of the ROU asset that is kind of derecognized. How much percent? Let's say 50% of the ROU asset is derecognized, and against that you will possibly find a gain or loss. So this is a little complicated. Over here what is happening is you will derecognize proportionately the lease liability and ROU asset and recognize a gain or loss on termination in the P&L. This is a 5-step working. This will always be based on discount rate on the date of modification. You will not take the original rate. All of these workings for all of these 6 circumstances will be based on the original rate only. Sir, what are the steps in case of lease modification? Well, step number 1, you find the lease liability at the commencement date, and then based on modification date, you can prepare a table like ICI does the same. 2 and 3 are for ROU. This will only be done in case there is a decrease in tenure or there is a decrease in scope. Otherwise, you don't need to do these steps. You can directly jump to step number 4. That is, you find the revised lease liability. This is the present value of the revised lease rent for the remaining lease term, discounted at the rate on the date of modification. This is never going to be at the original rate. So you'll find the original lease liability, compare it with the revised lease liability, and whatever is the difference will be the difference between the revised lease liability and the ledger balance of the original lease liability will be adjusted with the corresponding effect in the ROU asset. Profit and loss is not impacted. So over here, we will first try to apply these 3 steps in a couple of problems and see how the working is, and then we will see how to proportionately adjust ROU asset, and that will take care of this entire discussion. So if I were to review a few other problems on these lines, let us say there is question number 44, we can it's not an important question, but if you go to see what is happening over here is there's a 10-year lease of 2000 square meters. At the beginning of year 6, they agreed to amend the original lease for the remaining 5 years to include an additional 3000 meters in the same building. So there is an additional right of use. The additional space is made available at the end of the second quarter. That is fine. The increase in total consideration commensurate with the current market rate. So this is an additional right of use of 3000 square meters at the standalone price for the new 3000 square meters, which means I will take it as a separate lease. This will not be taken as a modification of existing lease because there is an additional right of use of 3000 square meters, and that is commensurate with the market price, and hence in such a case I will not find step number 1 existing lease liability, step number 2 revised difference. No, my existing liability will remain the same. I will find a new lease liability and I will kind of do the workings accordingly. Okay, so when we are looking at this question number 47, there is a 10-year lease for 5000 square meters of office space. At the beginning of year 6, the lessor and lessee agree to amend the original lease for the remaining 5 years. Agree to amend the original lease. So this is a new renegotiation to reduce the lease payments from 1 lakh to 95,000 per year. So there is a decrease in rent that is happening over here. The interest rate implicit cannot be determined, and the borrowing rate at commencement date is 6%. The borrowing rate at beginning of year 6 is 7%. The annual lease payments are payable at the end of each year. How should the modification be accounted for? Now, the first thing that you will ask yourself is there a separate lease? Sir, where can there be a separate lease if there is an additional right of use? Well, there is no additional right of use over here, and as a result, if there is no additional right of use, there cannot be a separate lease. Okay. Then you see that, okay, that means it is a modification of the existing lease. Within the modification, when do I do the 5-step approach? If there's a decrease in lease tenure, which is not the case, lease tenure remains the same, or a decrease in scope, which is also not the case, the area remains the same. It's a decrease in rent, for which you don't have to do a separate gain or loss calculation, and hence you do a 3-step working. So if I have to do a 3-step working over here, my first step will be to find the carrying value of the liability. I'll first find the carrying value of the liability on the commencement date, which is 1 lakh into the PVAF. So this is 7.36 at the rate of 6% for a period of 10 years. So this is 7,36,000. However, I need to find the liability at the end of year 5, start of year 6. So I'll prepare an amortization table. So over here, if I were to prepare an amortization table, this is 7,36,000. On this, you will have an interest at the rate of, let us say, 6% lease payment closing karte, you will come to a balance. Let us say your lease liability is 4,21,225. You will have to prepare a table. Okay, here there is a direct reference given, but you will have to prepare a table to come to this number. Now you will have to compare this with the revised lease liability. What is the revised lease liability? You will take revised lease liability as 95,000 discounted at the revised rate. What is the revised rate now? 7% for a period of 5 years. So if I do this, 95,000 discounted at the rate of 7% for 5 years, this comes to approximately 3,89,500. Now what is happening is, because of this modification, your liability, which was 421, is going down to 3,89,000, and hence your liability will be debited. So if your liability is debited, what is credited? Well, lease liability is debited. ROU asset, it makes your asset less costly here, and ROU asset is credited, and that is about it. So this is question number 47, where there is a modification, but that modification requires a 3-step approach. Similar is the case in question number 45 as well. It's similar case, okay, it will be broadly similar. Enters into a 10-year lease for 5,000 square meters. The annual lease payments are 1 lakh, payable at the end of each year. Interest rate implicit cannot be determined. The rate is 6% at the beginning of year 7. The lessor and lessee agree to amend the lease by extending the contractual term by 4 years. It is not that there was a renewal option and you are exercising that renewal option. No, there was no renewal option. 6 years have gone by. 4 years are remaining. Now you extend it by another 4 years. So 4 plus 4, 8 ho jayega. The annual lease payments are unchanged. That is at 1 lakh, payable at the end of each year from year 7 to year 14. So that is for remaining 8 years. The lessee's incremental borrowing rate is now 7%. How should the modification be accounted for? The first thing you ask yourself is there an additional right of use today? The answer is no. One can say that I'm getting 4 more years, but I'm not getting anything today. At today's terms, additional right of use would mean that today I had a ground floor, now I also have a first floor. That is not the case. Today I have a right on the first floor, I still have the right on the first floor. So there's no additional right of use today. So there's no separate lease. If I create a separate lease, I'll have to create a separate ROU asset and separate lease liability, which is wrong. Today, there's no separate right of use asset and liability to be recorded. Today, I have the same first floor only. And hence, it is not a separate lease. Secondly, in this case, there is an increase in tenure, not a decrease, not a sale. And as a result, we will take a 3-step approach. So if I were to take a 3-step approach, again, what I will do is initially, I will try to find, let us say, my lease liability is a present value of 1 lakh at the rate of 6% for 10 years, 7,36,000. I'll prepare this table and come to the carrying value after 6 years, that is 3,46,499. And then, because I don't want to find a gain or loss separately, I will try to find, let us say, my revised lease liability, which is based on the present value of the remaining. Let's say this is still 1 lakh into the PVAF, which is still at the rate of 7%, which is the revised rate for a period of 8 years. If I do this, I'll get around 5,97,120, as you can see over here, and hence the liability which is appearing at 346 is now 597. So there's an increase in liability by around 2,50,621. This is credit on the liability, and you will debit your right of use asset because you are getting more rights, so your ROU asset can be debited. So these are the questions pertaining to increase in term or a change in rent. However, we use the 3-step approach. Now there can be a 5-step approach where you are giving up, let us say, an area, or you are giving up, let us say, a tenure. In which case, how do I do? So when I look at question number 46, lessee enters into a 10-year lease for 5,000 square meters. Same, the annual lease payments are this time around 50,000. Earlier questions had 1 lakh. Payable at the end of each year. The interest rate implicit cannot be determined, and the lessee's incremental borrowing rate is 6% at the beginning of year 6. So at the end of year 5, lessor and lessee again agree to amend the original lease to reduce the space to only 2,500 meters. So this is to reduce the space. Okay, so am I getting an additional right of use? No. So there is definitely no new lease. However, am I giving up some area? Yes. So there's a decrease. How much am I giving up? Well, I'm giving up 2,500 out of the 5,000 I had, and hence I'm giving up 50%. I'm giving up 50% of the area. If I'm giving up 50% of the area, then there will be a derecognition of the original space starting from the start of the first quarter of year 6. The annual fixed lease payments from 6 to 10 are now 30,000. So you're giving up some area, so your lease payments will also change. The lessee's incremental borrowing rate is 5%. How should the modification be accounted for? Now over here, your step number 1 will be still finding the lease liability. So this is 50,000 into same 7.36. So maybe this will be 50,000 into 7.36 comes to around 3,68,000. This will be your lease liability as well as the ROU asset, but at year 0. I want to find the lease liability after year 5. So I'll prepare this table, and 368 I will start, and after 5 years I'll come to 2,10,613. So I find the carrying value of the lease liability at the end of year 5. I also want to find this for the right of use asset. Why? Because proportionate right of use asset is also given up. So what I will do is 3,68,000, and I will have to depreciate it. 3,68,000, unless given otherwise I will depreciate using SLM divided by 10 into 5. So this will be 1 lakh. What is 368? 84,000, and hence your proportionate ROU asset which is still remaining is 1,84,000. Now if I go to 1,84,000, this 1,84,000 is for me getting the right of use of 5,000 square meters for 5 years. However, I'm immediately giving up 50% of my right of use, and hence 1,84,000 into 50%, that is equal to around 92,000 of your right of use asset has to be derecognized. So I will derecognize ROU asset as 1,84,000 into 50%, that is equal to 92,000. Now usually when I sell, I will get some consideration. Here I'm not getting a consideration, but I can always argue that the cash outflow avoided is similar to cash inflow. Like if I'm giving up 50% of my right of use as per ICAI, and we are just discussing in line with ICAI, there could have been alternative interpretations here, but as per ICAI, if I'm giving up 50% proportionately of my right of use, then 50% proportionately of my lease liability should also be derecognized, and hence whatever is my lease liability, 2,10,613 into 50% comes to, let's say, 1,05,306. Will or 307 will also be derecognized. So I will say ideally, if I'm giving up 50% of my right of use, ideally 50% of my lease liability should also be derecognized. So I derecognize 50% of the lease liability and 50% of my right of use, and thereby my entry over here will be lease liability account debit to ROU asset to gain on modification. So there will be a gain on modification coming to 13,307 in the PN. Now these are the two things that you had to solve. Like over here we said, step number 2, find the ROU asset at the start, which was 3,68,000, and the modification date, that is after depreciation, after SLM depreciation, if nothing is given. This is only needed if there is either decrease in lease term or decrease in scope, like in this question. Then find the proportionate ROU asset 50% and the proportionate lease liability, which is also, let us say in this case, 50% as per ICAI, to be derecognized. This is needed if there is a decrease in lease term or decrease in scope, and then pass the journal entry with the balancing figure taken to the profit and loss account. These two steps are only needed in case there is, in a way, a derecognition. So over here we did this working, and ideally we should have our revised lease liability. However, this is not the liability which is still remaining. Well, why? Because when we look at this liability, this is in my books 2,10,613 minus 1,05,307, which means I'm still having a liability of 1,05,306. However, my actual liability is based on 30,000 into the PVAF, this time around at 7% for the remaining 8 years. So this is, let us say, so liability in your books will be around 1,05,307 or 8. As a revised liability is 1,29,882. How did you get that? Well, 30,000 into PVF at the rate of, I think, 5%. Okay, sorry, 5% for a period of 8 years. 8 years. If you want, sit and calculate 1 divided by 1.05. 1, 2, 3, 4, 5, 6, 7, 8. This will be 6.9. divided by 1.05. 1, 2, 3, 4, 5, 6. So over here, just a second, let me. Oh, this is a different question, is it? 30,000 into PVF at the rate of 5%. Is there a change in the 10? Oh, sorry, my tenure is not changing. I'm just fixated. 8 years was in the earlier problem. So this is 1 divided by 1.05. 1, 2, 3, 4, 5. And you total up, this is 4.32. My bad. 7% and 8 years were both in the last question. So this is 5% for 5 years. Sir, बहुत हो गया अभी. 4.3295. So if I multiply 30,000 into 4.3295, I will get around 1,29,000. 885. Now, a lot of times students wonder that why we are doing the longer approach. Well, to start with, the institute is doing it, but in my opinion, that is correct. So what I mean, if I kind of draw a parallel, what is happening over here is, let us say I am teaching two subjects, FR and AFM. When you, let us say, take a combo, let's say FR is 100, AFM is 100, the total product is 200. However, I give a 10% discount, in which case it comes to 180. Now you, let us say, take FR and AFM, and then later you say that, let us say, I don't want AFM, for example, in which case I will say 50% of what I'm offering is not there, so I will reduce it. I'll say, okay, approximately 180 into 50%, that is equal to 90 rupees should be my liability. But the point is, if a person would have only purchased FR, I would not have given it at 90, I would have given it at 100 rupees. And hence what I do is, this entire journey, rather than doing a shortcut that is taking 180 down directly to 100, I take 180 down to proportionate liability, that is equal to, let's say, 90, and then increase the 90 by 10 rupees. If you understand the logic, what is happening over here is, I first find my existing lease liability in my books, I find my existing ROU asset in my books, I say that out of whatever is the ROU asset, let's say 2 subjects, one of the subject is given up, so 50% of the subject given up, so 50% of your right of use is credited. In a similar way, 50% of the liability should be debited. If 50% of the liability is debited, then ideally my liability will become half, but it does not. Well, because that one subject that is now remaining will cost you more, and hence you bring the liability down from 180 in my FRAFM example to 90, and then from 90 you increase the liability up to 10, that is take it to 100, so that will increase your ROU for the remaining. So over here what I'm first doing is, I'm saying that my liability is 2,10,000, I get it down to around 1,05,000, and then I said that liability, ideally 50,000 was my combined rent, so half of the property should have costed me 25,000, but it is costing me 30,000, and as a result I will take 30,000 into the PVF, that is 1,29,882 minus in my books 1,05,308, and hence 24,574 will be your ROU asset and a corresponding credit to the lease liability. Now this is inherently a little more complex, and this is something that you should kind of see if it comes in the exam, and there is one more question, we'll discuss that. But before that, if I were to summarize that, if there are any changes in the lease from the lessee's point of view, I will first see whether it is due to a renegotiation or if it is due to changes in your existing lease. So if there's no renegotiation, like question number 43 or 58 or 7 which we did, there was no renegotiation, CPI reset was already there, renewal option period was already there, in which case if there's a change due to renewal or purchase option, you take the revised rate, a 3-step approach. If there's a variable payment or becomes in substance fixed or residual value guarantee, then you take the original rate, in which case also you take the 3-step approach but with the original rate. Now if there's a renegotiation like you did in these questions, you first see if there's an additional right of use at the standalone price. If yes, then there is a new lease. If there's new lease, then there's no change in your existing lease working. However, if none or any one of them is satisfied, then you treat it as modification of existing lease. The moment it is modification, you have to ask yourself whether I take the 3-step approach or the 5-step approach. If it is more rent or less rent, more tenure, more area, then I take the 3-step approach. But if it is more tenure, no, it's not more tenure over here, sorry, this is, if there is less tenure or less area, then you will take the revised rate, which is a 5-step approach. So everywhere you will take the revised rate only, but with a 5-step approach, present value adjustment to be done in all of these cases. So when we look at the last one more question which is there, and here there is a bit of certain ambiguity. We will do it the way institute does, but that is because if you look at the standard, when you find a proportionate ROU asset or you find a proportionate lease liability, they say you take it in the appropriate ratio. Appropriate ratio has not been defined, like we took 50-50. Someone can take some other ratio as well. 50-50 was appropriate in that question. In this question also there is another ratio, but institute does it slightly differently and creates a lot of problem for students. So let me just discuss it now. So over here, question 48, lessee enters into a 10-year lease for 2000 square meters of office space. The lease payments are 1 lakh payable at the end of each year. The interest rate cannot be determined and the borrowing rate is 6%. So over here, if I were to do this working, I will take 1 lakh into the PVF at the rate of 6% for a period of 10 years. So this will come to, let us say that same 7,36,000 at the beginning of year 6. So end of year 5, lessee and lessor agree to amend the original lease. So there is a lease amendment to include an additional 1500 square meters of space in the same building starting from the beginning of year 6. So there is an additional right of use. There's an additional area, so there's an additional right of use, and reduce the lease term from 10 years to 8 years. So out of these 10 years, 5 years have gone by, so 5 years are remaining. Now we're reducing it to 8 years. So now there is 3 more years which are remaining. The annual fixed payment for the 3500 square meters is 1,50,000 payable at the end of each year from year 6 to year 8. So there is 3 more years where I have to pay 1,50,000 because I'm getting more area as well. Lessee's incremental rate at the beginning of year 6 is 7%. Okay. The consideration for increase in scope of 1500 square meters is not commensurate with the standalone price for the increase adjusted to reflect circumstances of the contract. So if you had to show this as a new lease, then the question should have told you that one, there's an additional 1500 of area and which is commensurate. In this case, it is not commensurate. Consequently, the lessee does not account for the increase in scope that adds the right of 1500 meters as a separate lease, which is correct. You cannot take it. How should the said modification be accounted for? Now, in this particular case, you might want to read the question again. But in this case, what is happening is there are a lot of changes that are happening. Like your rent, which was earlier 1 lakh, is now becoming 1,50,000. Your area, which was earlier 2,000, is now becoming 2,000 plus 1,500, that is equal to 3,500. And your tenure, which was earlier remaining 5 years, is now becoming just remaining 3 years. So there's a lot of changes. Basically, one of those changes is a decrease in tenure. And the moment there's a decrease in tenure, you will have to take the 5-step approach. Step number 1, you will calculate the carrying value, which is 7,36,000. Based on that, you prepare an amortization table and you will come to 4,21,225 at the end of year 5. Similarly, you will calculate the ROU asset, which is 7,36,000, and if you depreciate it, it will become 3,68,000. 7,36,000 after depreciation will become 3,68,000. Now what is happening is, I will say that this 3,68,000, listen to this very carefully. This is on the ROU. For the remaining 5 years, that is year 6, 7, 8, 9 and 10, how is this ROU going to be utilized? Well, in each of the years, there will be a depreciation which will be charged, that is 3,68,000 divided by 5, that is 73,600. Am I still going to use it for the first 3 years? Yes. But am I going to use it for the last 2 years? The answer is no. And as a result, I will not get the benefit of the last 2 years, and hence the proportionate ROU asset to be derecognized. The proportionate ROU asset to be derecognized will be 3,68,000 into 2 by 5, proportionate. So this is perfect. 368 into 2 by 5. Most students don't face a problem in that. 1,47,200 will be your ROU asset to be derecognized. Now, coming fresh from the earlier problem, you will say that that means a proportionate lease liability to be derecognized is also 2 by 5 of the lease liability. Now, remember, in lease liability, you had to pay 1 lakh in each of the 5 years. However, now you don't have to pay 1 lakh for which of the years, sir? I don't have to pay 1 lakh for the last 2 years. Can I say 1 lakh for the last 2 years have the same weight as 1 lakh for the first 2 years? The answer is no. Remember, for ROU asset, depreciation for the last 2 years below is also 73,600. Depreciation for the first 2 years also is 73,600. But when I look at the lease liability, my lease liability is not 5 lakhs. If my lease liability was 5 lakhs, that means 1 lakh for each of these periods, then I would say 2 by 5 of my lease liability will be derecognized. However, my lease liability is the present value of these 1 lakhs, and hence if 2 of these 1 lakhs are not paid, if I want to do it accurately, ideally I should find out the present value of the last two 1 lakh payment which are no longer going to come and derecognize that. So I'm in a way taking 2 by 5, but rather than taking a flat 2 by 5, I'm taking the present value for the last 2 years of this 1 lakh over the total 5 years ka present value. So what I do is, I say for lease liability in my books, this is 421 225, which is made up of maybe 1 lakh for the upcoming 3 years and 1 lakh for the last 2 years. So if I take for the last 2 years 1,53,925, I don't have to pay this 1 lakh for the last 2 years, and hence I will derecognize 1,53,925. So when I look at the journal entry, my journal entry over here will be, my liability will be debited by 153,925 to my ROU, which will be credited by 147,200, which means there will be a balancing figure which will be a gain, which will be taken in the profit and loss. Now a lot of students say we want to take simplistically 2 by 5. Can it work? Well, possibly it can work, but Institute has done this considering present value. In my opinion, that is correct. So in the last question they did not take present value because the time frame did not change. Last question the time frame was 5 years only and it did not change, so there was no present value gain. Yahan pe 5 years is going down to 3 years, and hence the 2 years which are no longer there for a liability, which 2 years are removed is important, and hence 421 is not 4,21,000, which is your ledger balance, is not actually 1 lakh into 5. It is 1 lakh into the PVAF for the coming 5 years. So which of those two 1 lakhs are going out is important, and considering that, around 1,53,925 should be derecognized. And if I take the difference 153,925 and this, it is 6,725, so probably 6,725 will be the amount that will go in the profit and loss account. Okay, I think they have not given this entry here, but this is the entry which should come. Now after this, your liability will come to what? Well, it was 421 225 minus 153,925, which means your liability now is approximately what? It is around 267,300. Okay, now my revised liability at the end of year 5 will be 1,50,000 into the PVAF at whatever is the rate for the period of 3 remaining years. So my revised rate, I believe, is around 7%. So I will take 7% for the 3 years, and that will come to around 3,93,000. So my liability, which was at 267, is coming to 393, and hence over here my liability will increase. 393,645 minus 267,300, there's a 1,26,000 increase in the liability, and my right of use will increase. Why? Because I'm getting more area. Sir, but I should show it as a separate. Well, you don't need to show it as a separate, because over here it is not commensurate with the standalone price, and that is about it. So this is a slightly tricky thing, and hence we have given a detailed reference note that the lease tenure is reducing. Hence we are giving up the ROU for the last 2 years. Depreciation for last 2 years and first 3 years will be the same, and the recognition of ROU is directly 2 by 5. However, lease liability includes an obligation to pay 1 lakh over the remaining 5 years, of which we don't have to pay 1 lakh for the last 2 years. But due to time value, 1 lakh of the last 2 years is not the same as 1 lakh over the earlier years, and hence we cannot ideally take 2 by 5. Institute has also not taken in the standard, they've just said appropriate ratio, and hence you will have to figure out what is the appropriate ratio. So instead we need to derecognize the present value adjusted amounts. The above adjustment is to be separately done for ROU asset and lease liability if a lease tenure is decreasing. In earlier problem, the remaining tenure was at 5 years, and hence we took the same proportion 50%. Here, because the tenure is changing, you have to do a slight modification, and this is the journal entry that you also have to pass. And I guess that should be it. After this, what you are left with is a few special cases and the lessor accounting, but largely when you look at the lessee accounting, that kind of gets covered. Okay, so we'll continue further into the lessor accounting. So we discussed about accounting from the perspective of the lessee. Now from the lessor's point of view, now more important I would say honestly is the lessee accounting, but in case it comes in the exam, we should also be aware of what is to be done in the case of a lessor. So if I were to do, let us say, accounting from the lessor's point of view, we kind of still retain the concept of operating lease and finance lease for the lessor. See, in the lessee, we are creating a right of use and a lease liability, but for lessor, as per Ind AS 116, we still retain the concept of operating and finance lease. What is a finance lease? Well, finance lease is defined as a lease where substantially all risks and rewards incidental to ownership are transferred to the lessee. So substantially all the benefits are transferred to the lessee. There are certain 5 indicators which are given for finance lease. And how is operating lease defined? Well, every lease other than a finance lease is taken to be an operating lease. So when I look at the lease classification over here, there are 2 ways. First is a finance lease where substantially all risks and rewards are transferred to the lessee. An operating lease where every lease other than a finance lease is called as an operating lease. Now, what are the 5 top indicators in case of a finance lease? First, if the ownership of the asset automatically transfers, like a hire purchase where the ownership is transferred, then substantially all the benefits will be enjoyed by the lessee only. Second, if let us say the ownership is not automatically transferred, but there's a purchase option which is available to the lessee, which is at a substantially lower price. So this is purchase option which is substantially lower than the expected market price. Then it is highly likely that the option will be exercised, in which case the lessee will take the asset and enjoy all the benefits. Third and fourth I would say are the most important ones. The third point says that if the lease term covers a major part of the economic life, major part has not been specifically defined, but more than 75% is usually taken to be a major part of the economic life, or the present value of lease payments substantially cover. Now when you look at the language, substantially cover is more heavier of a term. Substantially covers the fair value. So over here, this is present value of the minimum lease payments substantially cover the fair value of the asset, that is more than 90%. Ideally, if I were to take something on rent, I will not pay almost equal to the market value. But if I'm almost paying equal to the market value, like if I'm paying more than 90% of the market value, then it is highly likely that I will be enjoying substantially all of the benefits. And lastly, the asset is of a highly specialized nature and can be used by the lessee only and by no other entity except for making major modifications. Like for example, if I take a rocket launcher on rent, if I'm ISRO or if I'm NASA, I'm taking a rocket launcher on rent, in which case substantially all the benefits will be enjoyed by me only, because that is something no one else will be able to use. So do I need to meet all the 5 conditions? The answer is no. If any one of those 5 conditions are triggered, then this lease becomes a finance lease. If all of them are not triggered, then it is an operating lease. If it comes in the exam where you have to identify between operating and finance, you will first look at these 5 conditions for finance. If any one of them is getting met, let's say the lease term is 9 years and the economic life is 10 years, in which case you will say that the lease term covers a major part of the economic life and hence it is a finance lease. I don't have to show the fulfillment of all of these criteria. However, in case it is operating lease, I need to show that all of them are not getting fulfilled, and that is why it is an operating lease. So initially there is an identification of finance as well as operating lease. Once you are able to, in the books of the lessor, identify an operating or a finance lease, then you go to the accounting. The accounting in case of an operating lease is, see, in operating lease the risk and reward is not transferred to the lessee. It is finance lease where the risk and reward is transferred, in which case if I am the lessor, if I have a property and if I am giving that property out on rent, the risk and reward of that property is not getting transferred to the lessee. If it is not getting transferred to the lessee, then I would say that the given lease is an operating lease. If it is an operating lease, the asset, that is property which is there in my books, will continue to remain in my books only. I will not derecognize a property. It will continue to remain in my books only. Okay, so the property will remain, but then I will have to record, let us say, rent. So when I'm calculating the rent income, I will say bank account debit to rent income, and that rent income will be credited to my profit and loss account. It will be a very relatively straightforward and simplified accounting where you say bank account debit to rent, and then that rent will be transferred to the profit and loss account. That's about it. There are a few complications over here in case of straight lining of rent, but if I keep that straight lining adjustment separate, I will look at, let us say, this concept of operating lease, and then I move on into finances. When I look at finances, what are the differences in terms of operating lease versus finance lease? Well, in finance lease, the law says substantially all the risk and reward incidental to ownership are transferred to the lessee. So if all the risk and reward are transferred, ideally the asset should be derecognized. If I have the property which is, or let's say I have an aircraft which I'm giving out on rent, let's say the useful life of the aircraft is, let's say, 10 years and I've given it out on rent for 10 years only, then substantially all the risk, all the reward incidental to ownership are enjoyed by the lessee, in which case the lessee should ideally derecognize the asset, and hence At the time of finance lease, initially I will pass an entry. At the time of operating lease, I don't need to initially pass any entry, but in case of finance lease, I will initially pass an entry. So my entry over here will be, I will de-recognize the asset. In case of a regular lessor, I will de-recognize the asset, and in return, I will recognize what? Sir, I will recognize the lease receivable. Why? When I'm a lessee, I have an obligation to pay, so I recognize the lease liability. But if I'm a lessor, I have a right to receive, and as a result, there will be a lease receivable. So if I'm given a property out on rent, let us say this term is 5 years, its rent is 100 rupees. I will take the present value of that, so that is 100 rupees discounted at whatever is the rate for 5 years. Let's say it comes to 379. In which case I will debit the lease receivable by 379. It's a receivable. To let us say I will credit the asset. At what value will I credit the asset? Well, whatever is the WDV, whatever is the carrying value, WDV, I will credit the asset, and the balancing figure over here will be taken as a gain or loss. If let us say there is a finance lease, the asset no longer appears in your books. If it is an operating lease, the asset continues to appear. In case of operating lease, in which case the depreciation on the asset will continue to be taken by the lessor. Now, a lot of times students have this doubt that, sir, if let us say I look at a lease, there is a possibility that depreciation can be in the books of the lessor, also in the books of the lessee as well. Yes, in the books of accounts it is very much possible, sir, but that will result in some tax manipulation. Remember, income tax records are different. Income tax, when you study paper number 4, they will tell you they don't recognize the concept of operating lease, finance lease, right of use. They say that person who owns the asset will claim the depreciation, person who takes the asset on rent will not claim the depreciation. That is a very simple rule under income tax, if that doubt comes in your mind. But otherwise, if you look at, let us say, the concept of finance lease, I will de-recognize the asset. So over here, in case of operating lease, initially I will not de-recognize anything, so there will be no entry. Further, I will say bank account debit to rent income, and this rent income will go to the profit and loss account. That's about it. There's some deferred rent or lease equalization which we will study. But in case of a finance lease, I will de-recognize the asset which is at the WDV and recognize the lease receivable. Typically, the lease receivable will be at the present value of the lease payments. Actually, this is called as net investment. We will study how the net investment is calculated, and the balancing figure will either be a loss or the gain, as the case may be, on this transaction. Now, if I have de-recognized the asset, there cannot be any depreciation. However, if there's a lease receivable, like lease liability has an interest expense, lease receivable has an interest income. So if you start with 379 into, let us say, 10%, it is 37.9 will be your income, called as finance income or interest income. Lease receivable account debit to finance income will be 37.9. Later you will recognize, let us say, the receipt. So bank account debit to lease receivable 100, and this will keep on going. So instead of charging, let us say, a depreciation, instead of showing separately a rent income like I do in case of an operating lease, in this case I will not charge any depreciation because the asset has been de-recognized, and on lease receivable I will show an interest income. So this is lease receivable account debit to finance income or interest income, and then bank account debit to lease receivable. That's about it. Now there are two special things. One, in case of finance lease, where you need to study how this lease receivable is actually calculated, and secondly, in case of operating lease, to calculate how this deferred rent is worked out. Now, when you calculate lease receivable, this is calculated as something called as net investment in the lease. How is net investment calculated? It is the present value of lease payments. Lease payments will include what? Fixed lease payments, even variable lease payments which are linked to rate or index, even payments under purchase option, termination, residual value guarantee, all of these will be included. However, apart from present value of lease payments, I will also add the present value of something called as the unguaranteed residual value. This term will create a ruckus when you actually do the lessor accounting, something called as unguaranteed residual value. What do you mean by UGRV or the unguaranteed residual value? It actually means that over here, when you do this working, the unguaranteed residual value, you will actually find the working. Sir, but in this working, why should UGRV, or what is unguaranteed residual value? Let us say, for example, I'm a lessor. I've given this property out on rent for a period of 5 years. After 5 years, the property is going to come back to me. Now, after it comes back, let's say the lessee has not given any guarantee for making any payment for the residual value. However, I believe that after 5 years, when this property comes back to me, it will still be worth, let's say that property was earlier worth 10 lakhs, it will still be worth 2 lakhs. When I calculate IRR, the discounting factor over here will be based on the lessor's IRR, because I'm in the books of the lessor. I'm not in the books of the lessee that I take lessor IRR or incremental borrowing rate. I am the lessor's IRR. Lessor will know the fair value. Lessor will know the initial direct cost. He will know the lease rent. He will know everything. And as a result, if I'm in the books of the lessor, my discounting factor is lessor's IRR. But lessor's IRR is calculated by comparing the fair value plus the initial direct cost with the present value of, let us say, the lease payments and also the present value of salvage value. When you do capital budgeting, when you do IRR calculations, you take the salvage value whether it is guaranteed or unguaranteed, and as a result, when you do the calculations, we will do the workings considering the unguaranteed residual value, because the IRR over here would have taken the unguaranteed residual value as well. So whenever you are doing accounting in the books of the lessor, the IRR, which is a discount rate, would have been calculated considering the salvage value, whether it is guaranteed or unguaranteed. Now, it is very much possible that the salvage value that you are expecting is 2 lakhs. However, the lessee has given you guarantee that at least up to 50,000 I will pay. So 50,000 you are going to certainly get. So that is a 50,000 is a guaranteed residual value, must be a part of my let us say lease payments. However, anything beyond this 50,000, that is another, for example, 1 lakh 50, 2 lakh minus 50,000, that is 1 lakh 50 is called as the unguaranteed residual value. From a student standpoint, from an exam perspective, you can just remember the unguaranteed residual value is the expected residual value minus, let us say, the guaranteed residual value. That difference will be taken as the unguaranteed residual value, and UGRV will be taken into the lease receivable calculation. Another logic for taking UGRV into the lease receivable calculation, one is it should be based on lessor's IRR. The second logic over here is, let us say the property is given out on rent, let us say for a period of 9 years, and the useful life is 10 years. I am derecognizing the asset. If I am derecognizing the asset, currently the asset is not in my books, but 9 years later I am going to get the asset back. There is no purchase option, there is no automatic transfer, so I am going to get the asset back. At the end of 9 years, I am not going to pay anything, the lessee is not going to pay anything, but the asset has to come back. At what value will it come back? Well, it will come back at the residual value. Like, for example, if the residual value was 2 lakhs and I have taken this into the lease receivable working, after I prepare the amortization table, after, let us say, the lease term, you will be left with 2 lakhs. And in lieu of that 2 lakhs, the lessee will give you the asset back, in which case your entry will be asset account debit, let us say, to lease receivable. So you can recognize the asset back again at whatever was the residual value that you were expecting at the end, and hence unguaranteed residual value, long story short, has to be taken into your calculation of your lease receivable as well. So over here, on derecognizing the asset, I'm going to get, let us say, a stream of cash flows, let's say for 9 years, and then maybe the asset back also after 9 years, and that is measured by the unguaranteed residual value. So that is an important piece of information which is considered for the lessor, not for the lessee, because the lessee does not really care. It is a lessor's asset that I'm giving it back to the lessor. So lessee, it's not a separate payment, the UGRV. But for the lessor, because you're derecognizing the entire asset, when it comes back, at what value will you recognize? You will recognize at the expected residual value. And hence UGRV, long story short, should be taken while calculating IRR, while also calculating the net investment, which is the present value of your regular lease payments plus the present value of the unguaranteed residual value. Now, there are other lessor specific terms, like there is also something called as a gross investment. When you look at gross investment, it just means, like, for example, if your lease was 100 rupees for 5 years, plus let's say at the end of the 5th year there was an unguaranteed residual value of 50 rupees, then your gross investment would be, for example, 550, whereas a net investment would be the present value, that is 100 into the PVAF at whatever percent, let's say at the rate of 10% for 5 years, which comes to 3.791 plus 50 into 0.621. So if I do this working, this is what, 50 into 0.621, and this comes to around 410.15. So this is called as net investment. You will recognize the lease receivable at what we call as a net investment, and the difference between the two. Why is it different? Well, it is different because of time. The only reason why the net investment and the gross investment is different is because of these present value factors, and hence the difference between 550 and 410.5 is called as the unearned finance income. So these are three lessor specific terms where you should be aware that the lease receivable should be shown at what, sir? It will be shown at the net investment in the lease, and the net investment is calculated as a present value of the gross investment. There is a present value of lease payments plus the present value of UGRV. However, when you have to determine whether the lease is an operating lease or a finance lease, here you will exclude the UGRV. Why? Because the lessee is not paying it. So if you want to figure out whether the lease is operating or finance, you do not take UGRV into the calculation. However, if you want to, once you decide whether it is operating or finance and you want to show the lease receivable, UGRV will be taken. So it is a little confusing, and hence we have made a chart for this. Just hold on. Unearned finance income is the difference between gross and net. UGRV is expected residual value minus a guaranteed residual value. At the end of the lease term, the lease receivable will appear at the expected residual value, and once the asset comes back, you will pass the entry asset account debit, let us say, to lease receivable for this amount. Now, if I look at the summary of unguaranteed residual value, UGRV, for the lessee, it has to be fully ignored. You will not consider anything for the lessee. But when you look at the lessor, for IRR working, this will be included as a cash inflow. Why? Because when I do capital budgeting, in that I take the entire salvage value in my IRR working without bothering whether this is guaranteed or unguaranteed. Then you look at lease receivable in case of a finance lease. Let us say there is lease receivable in case of a finance lease. In this case, it will be at net investment, and if it is included in the net investment, you will take this into your overall working. And the assessment of a finance lease in the present value of MLP. So over here you will not include. So the assessment of finance lease in the present value of MLP, well, this will not be included. Okay, so when we do this overall working, this is how your UGRV will actually be appearing. Next, in the lessor's books, so that is a special case for lease receivable. Long story short, lease receivable is the present value of the lease payments plus the present value of unguaranteed residual value. The guaranteed residual value, if any, will already be a part of the lease payment calculation. So this will be your lease receivable. And when I look at operating lease, I don't need to worry about present value, etc., because in case of an operating lease, I do not derecognize the asset, I do not create a lease receivable, however I recognize the rent. But the problem over here is I can structure the rent in a way which is not equal, but the standard over here says that you will recognize the lease rent on a straight line basis unless any other systematic basis is more evident. Like for example, over here, if you go to see the lease, there's a 4-year lease with a 10,000, 20, 30 and 40. So these are different lease payments. Ideally, if this clause was not there for straight lining, I would have said the rent in the first year is 10,000, second year is 20,000, 30 and 40,000, as the case may be. However, when I'm looking at, let us say, a straight line lease rent, this will be what? 10 plus 20 plus 30 plus 40 divided by 4. This comes to, let's say, 25,000. So when I find, let us say, the lease rent, the straight line lease rent, this will be, let us say, 25,000 per annum. Now, my actual receipt in the first year is going to be 10,000 only. So my entry will be bank account debit 10,000, to rent income 25,000, and 15,000 will be in deferred rent. Some people also call this as lease equalization reserve or lease equalization account. In the second year, 20,000, still 25, and then 5,000. So 15 and 5, that is 20,000, is appearing in the deferred rent. Then in the next year, it's a law of averages. Bank account debit 30, to rent is 25, and then deferred rent is created by 5, and then by 15, and ultimately deferred rent becomes 0. Now, why is this done? Because the standard believes that rent is usually a fixed cost. Unless there is a systematic basis for the rent to be deferred, it should not be different. You can manage profits, manipulate profits by having different rents. However, if the property is the same, asset is the same, it should not have a different rent. And if it does, the standard requires you to do a straight lining. Sir, this is mandatory? Yes, unless there is a systematic basis. An example of a systematic basis is in the first year, let's say you have 100 square feet, in the second year 200 square feet, third year 300 square feet, yes, then there's a reason why the rent is different. Or maybe there's an escalation which is in line with inflation, maybe 5-10%, but here the rent is doubling. That is not in line with inflation, and hence there's no systematic reason why this rent is differing, in which case you'll have to recognize a straight line lease rent only. Remember, this problem will only arise in case of operating lease. In case of a finance lease, such a problem will not arise. Just a second, please. So this problem is more of a operating lease problem, and this treatment needs to be done for straight lining of lease rent in case of operating lease. It should be recorded on SLM basis unless there is any other systematic basis which is more representative. This is something which is especially useful when you have things like a lease incentive, like for example, the landlord gives you a rent-free period, or the landlord, for example, gives you certain lease incentives. Then ideally, even if my rent is 100 per annum for a period of 4 years, however, this is my rent. Let's say there is an incentive that the landlord gives me. For example, there is an incentive of, let us say, what do we say, 80 rupees, in which case 100 into 4, this is my cash inflow, minus 80 that I have to pay as a cash outflow, divided by 4. So this will be 320 divided by 4, that will come to 80 per annum. Sir, why? Well, because lease incentive of 80 you can show as an expense, but that expense will only be recorded in the first year. Is that correct to show this only in the first year? The answer is no. because if this expense is only shown, for example, in the first year, it will not be able to be truly compared with, let us say, an incentive to be or an income which is to be recorded over 4 years. So effectively what you do is, rather than showing 100 as income over 4 years and 80 as expense, I'm in a way showing just 80 as net income. So that is a straight line lease rent. Okay, remember the incentive is for the lease and not just for the first year of the lease. This is an important thing. So these are the two important points when it comes to the accounting. Now there is a special case when it comes to the lessor, which is pertaining to something what is a manufacturer or a dealer lessor. Now all sums that we, or all the examples that we discussed over here is for a regular lessor. So what happens in case of a regular lessor? Well, in case of a regular lessor, there will be no separate trading business or manufacturing business like I am Bajaj Finance or Mahindra Finance or Cholamandalam Finance. Let's say if a farmer wants to buy a truck or a tractor, they will go to a showroom, they will select a tractor, they don't have money, they will call up an NBFC and they will say that I want to buy it, let us say, on a hire purchase basis. The NBFC will make the payment and the farmer will, let us say, pay off by paying the installments, which includes interest. That is the income for the NBFC. However, if you look at someone like Boeing manufactures aircrafts, but people don't have enough money to buy an aircraft. So Boeing has its own lending unit where Boeing says that, well, you know what, I will manufacture an aircraft. Let's say the aircraft costs you around 75 rupees. So inventory for Boeing is around 75 rupees. However, I have two options. I'm either ready to sell you the aircraft as it is, for example, at 100 rupees, or 92 rupees, whatever it is, or I am going to give you an agreement whereby I will give you an asset on lease for the remaining tenure. So I will give it to you on a lease basis, 15 rupees for a period of 10 years. So 15 into 10 comes to 150. No, for something worth 75, I'm getting 150. So that additional, is it interest? Well, not entirely. Why? Because there is a possibility that the part of it is trading profit. Like for example, the cost of the inventory is, let us say, for example, 75, the fair value or selling price is around 92.18, which means even if I don't give it out on lease and even if I have to sell it, 92.18 minus 75, that is around 17 rupees is my trading profit. However, my total collection will be maybe 15 into 10, that is equal to 150. So I will say that this gap is more like a gross profit, trading profit. But this gap additionally over this is more due to the unearned finance income. This will be the interest that I will eventually earn. A pure lessor who is not a manufacturer or dealer will not be able to procure the aircraft at 75. They will, if they have to give an aircraft on long-term lease, they will buy it from Boeing at 92 and then give it at 15 rupees for a period of 10 years. So what they will earn is just the interest income. But what Boeing will earn is, apart from the interest income, it will also earn, let us say, trading profit. And in such a case, what does the standard say? The standard says that in case of a finance lease, for example, I will recognize a lease receivable at what value? Well, the present value of, let us say, the lease payments plus the present value of UGRB, that is as per Ind AS 116, I will recognize a lease receivable at the net investment. 2. What will I credit? Well, I will credit the asset. However, the asset in my books is only at 75. Now, the problem is I usually credit assets when I sell fixed asset. When I sell an inventory item, do I credit the asset? No, sir. When I sell a fixed asset, now my entry is bank account debit to asset and the balancing figure is gain or loss. But when I sell an inventory unit, I don't say bank account debit to asset and balancing figure gain or loss. No, I will pass two entries, either bank or debtor account debit to sales, and then let us say COGS account debit to inventory. And hence ideally there will be two entries. Now Institute combines this into a single entry, but ideally there will be two entries. One is lease receivable account debit to, let us say, sales. So at what value will you recognize? Well, I will recognize it at the present value of the lease payments. Now what are the present value of these lease payments? Well, I will probably take 15 rupees into PVF at the rate of 10% for 10 years. 6.145. Just a second, please. Okay, so you will book sales. At what value will you book sales? Well, at the present value of the payment. So this is 15 into 6.145 comes to 92.18. So let's say you are booking sales of 92.18, and against that there will be a lease receivable also of 92.18, ideally, that you will book. Now there would be, for example, so this is your sales entry, it's like a credit sale entry. In a similar way, there will be also a COGS entry, so there will be a cost of goods sold which will be debited to the P&L to what? Let us say inventory. So there is an inventory worth 75, and then there is a COGS which is also coming at 75. So this will kind of take care of your transaction. So if you go to see your entry is lease receivable account debit, COGS account debit. So basically this is one entry, lease receivable account debit to sales, and this is the second entry, that is a COGS account debit to asset, and that will give you kind of the composite effect. Now most of the times if it was still here, things are a lot more logical. The only problem comes if there is a UGRV. If there is an unguaranteed residual value, then lease receivable working says that you should be taking the unguaranteed residual value into consideration. So over here they say that the lease receivable should take the unguaranteed residual value. So this will be, let's say there is an unguaranteed residual value of, I don't know, just a second. Let's say around 20. So if your UGRV is 20, this is after 10 years. Then you will take the present value of that into 0.385. This will come to around 7.82 approximately. This is the present value of UGRV. So your net investment will now be 792 plus 7.82. So this will be 100. Okay, now the problem is when you book the sales will be based on the fair value of the asset today, excluding the UGRV. This is what the standard says. This should be minus the PV of UGRV. Why? Because this is, see, lease is covered by Ind AS 116. However, the sale is covered by Ind AS 115. Revenue recognition says you can't book revenue till the time the sale actually happens. Now, for let us say this asset, customer has agreed to pay you 15 for a period of 10 years. Later you think after 10 years you will get the asset back and you will sell it outside and earn 20 rupees. For that the sale is not consummated, and hence ideally my entry should have been 100 credit. However, if I credit the entire 100, in that I'm also booking kind of a part of 7.82. So this is 100 minus 7.82, which will come to what? This is 92.18. This is 92.18, and matching concept says that if your sales are excluding the UGRV, your COGS will also be excluding the UGRV. So this is 75 minus 7.82. So this is 75 minus 7.82, and then 67.18. So this will be 67.18, and that's about it. So long story short, when you have a lease receivable, this will be at net investment only, that is your present value of lease payments plus PV of UGRV. And if there is, let us say, something like sales, you cannot take the PV of UGRV, because the logic over here is 115 says that the revenue can only be recorded when the sale happens. For 15 into 10, present value of that money is going to be received, but for the additional amount it is not yet certain, and hence you cannot book it as a part of sales. So you will remove it. Matching concept says that if it is not a part of sales, it cannot be even a part of COGS, and this is how your entry will flow. The only other complexity over here that can come, and we do sums on this as well, is if there's an initial direct cost. If there's an initial direct cost, there will be a two bank for the payment for the initial direct cost, and separately you can either debit the IDC or you can add the initial direct cost as a part of your larger COGS, which will ultimately go to the profit and loss account. So this is the accounting in case of a manufacturer or a dealer lessor. We will take manufacturer or dealer lessor working only if the question specifically requires us to do that. Otherwise, we do not need to take the manufacturer or dealer lessor into our consideration. Perfect. So this kind of takes care of the lessor accounting, after which there are a couple of special cases like sublease, sale and lease back, as well as transition approaches, but this kind of takes care of that working. So if I were to look at the questions for, let us say, the lessor, so that we get relatively better understanding, there's one question which is question number 55, which is more like an inter-CA question. It came in the exam, but this is kind of assessing whether the lease is a finance lease or an operating lease, and then doing the accounting. So let us review it once. So there is Coops, who availed a machine from Ferrari. So Coops is a lessee, Ferrari is a lessor. Terms are, lease period is 3 years, machine is costing 8 lakhs. Machine has an expected life of 5 years. So this is 60% of the life, and hence it is not meeting the finance lease condition. Machine reverts back to Ferrari on termination of lease. So condition 1 and condition 2, that is ownership getting transferred or a purchase option, not fulfilled. So first three conditions are not fulfilled. The unguaranteed residual value is estimated at 50,000 at the end of year 3. This is a UGRV, and 3 equal annual installments are made at the end of each year. Now the problem is they have not given you what is the amount of the 3 equal annual installments, so that is why I am discussing this. The IRR is 10% and the PV factor at is given as 0.7513 and the annuity factor is given as 0.24868. That is why you are required to ascertain whether the lease is a finance lease or an operating lease. That means this is asked in the books of the lessor. Remember, assessment of finance lease or operating lease will only be in the books of the lessor, not in the books of the lessee. And also calculate something called as the unearned finance income with the relevant context to Ind AS. So if I were to do the working over here, I will first say that the first three conditions of finance lease are not met. The fourth condition is, what is the present value of the minimum lease payment? This is excluding the UGRV as compared to the fair value. So if I look at the fair value of the machine is, let us say, 88 lakhs. Now I need to find the PV of MLP, minimum lease payment, for which I need to find the lease payments. Now how will I find the lease payments? Well, at IRR, that is at 10%, your PVCO, present value of cash outflow, has to equal to the PVCI, that is the present value of cash inflows. So over here, if I take the present value of cash outflows, I will have to spend 8 lakh rupees for the machine, which equals X into, what is the lease rent? I don't know. X into 2.4868 plus UGRV, which is around 50,000, into 0.7513. If I do this working, ultimately my X will come up to, let us say, how much is that? 3,06,593. This is my equal annual lease payments. If that lease payments is not given in an exam question, remember you can use the IRR formula and try to find that answer. So this is 3,06,593, and if I want to find the present value of that, I will say that okay, 3,06,593 into the present value annuity factor, this is 2.4868, will come to around 7,62,435. Now if I compare 762,435 with, let us say, 8 lakhs, I will get approximately 95.3%, which means it covers substantially the present value of lease payments. Even if I don't take the UGRV, over here I have not taken the UGRV for assessment of a finance lease. Even if I don't take the UGRV, I will say that this covers substantially the fair value, and hence 95.3% this will be a finance lease. So the working over here, you will get a finance lease. So the first thing is it is a finance lease. Second, they are asking to calculate unearned finance income. Now how do I calculate unearned finance income? That is gross investment, 3,06,593 into 3 plus 50,000. This is your gross investment minus your net investment. Net investment is 3,06,593 into 2.4868 plus 50,000 into 0.7513. If I do this, I will get the gross investment to be 9,69,779, net investment to be 8 lakhs, and hence 1,69,779 will be my unearned finance income. So this is a slightly interesting question, question number 55. Then there is another question which comes pertaining to manufacturer lessor is 59. We'll review that, but before that, there's a question 60 which is on the lessor straight lining of lease rent. How will entity Y account for the incentive in the following scenarios? First, entity Y, who is the lessor, so the accounting is for the lessor, enters into an operating lease, very clearly given that this is an operating lease, with X for a 5-year term at a monthly rental of 1,10,000. So that's a straight line rent of 1,10,000, which should ideally go to the P&L. In order to induce X to enter into the lease, Y provides 6 lakhs to X at lease commencement for lessee improvements, that is lessee's asset. So the lessee is saying, oh, your flat is unfurnished, I want to give this out on rent, and hence I say that okay, you are paying me 1,10,000 of rent each month for a period of 5 years. I will give you 6 lakh rupees. You can do whatever renovation you want. These are your assets. If you want to take it away, you can take it away. In which case, as a lessor, I will have to record rent income. How will I recognize rent income? The rent per annum will be 1,10,000 per month into how many months are there? 5-year term, and hence this is 60 months minus, I would take 6 lakhs, and hence if I divide this, for example, by 60 months, so this is 66 lakhs minus 60 minus 6 lakhs divided by 60, this is equal to 1 lakh per month. So your entry in each month will be bank account debit 1,10,000. So when you give this amount your entry will be deferred rent account debit, let us say 6 lakhs, to let us say bank 6 lakhs, and then every month when the entry is passed, your entry will be bank account debit. I'll receive 1,10,000 to rent income, which will be 1 lakh, and 10,000 will be adjusted from the deferred rent. So deferred rent over a 60-month period, 10,000 into 60, 6 lakhs will be adjusted. This is how your accounting will be. Now scenario B is exactly the same, just that the last part is different. In scenario B, you are entering into operating lease for again a 5-year period. Monthly rental is 1,10,000. 6 lakhs is provided for lease improvements, but these are owned by entity Y. That is, these are lessor's assets, in which case I cannot say that 6 lakhs is a lease incentive. In which case this is 6 lakhs that I'm paying for my own PP. So this is my rent will be still 1,10,000 each month. 6 lakhs over here is not a lease incentive. I will say something account debit to bank, PP account debit to bank. It is my own assets which I can later depreciate as well. So over here you see the estimated useful life of the leasehold improvements is, let us say, 5 years. In this case you will kind of depreciate. Now question number 59 is on this manufacturer and dealer lessor, and you had to pass this entry. So this is an entire through the cycle working. A company manufactures specialized machinery. Company manufactures. So you are in the business of manufacturing. The company offers customers the choice of either buying or leasing the machinery. The customer chooses to lease the machinery, and the details of the arrangements are as follows. So over here you will have, let us say, lease commencement on 1st April for 3 years. The lessee is required to make 3 annual payments of 57,500. So all of that is given. The leased machinery is returned to the lessor at the end of the lease. So condition 1 and condition 2 are not fulfilled. The asset does not, ownership automatically does not get transferred. There is no purchase option as well. The fair value of the machinery is 1,50,000, which is equivalent to the selling price of the machinery. That is fine. The machinery is costing 1 lakh to manufacturer. The lessor incurred 2,500 to negotiate and arrange the lease. So that is an initial direct cost. The expected life of the machinery is 3 years, and initially you have been told that the lease term is also for 3 years, which means this is a finance lease. It covers the entire economic life. The machinery's expected residual value is 10,000 at the end of year 3. The value does not change over the term of the lease. So this is your residual value. The interest rate implicit is 10.19%, and the lessor classifies it as finance lease. Even if it was not given, we know it's a finance lease. How should the lessor account for this in the books of accounts? Pass the necessary journal entries. First of all, we have been given that this is a manufacturer plus he is also the lessor. So over here the accounting is going to be slightly different. So when I look at the manufacturer / lessor, I will first try to find, let us say, the entry initially. This is a finance lease, so I will have to de-recognize the asset. So the asset will be credited by 1 lakh. To asset credited by 1 lakh. Asset is going out, but something is debited. Sir, what is debited? Lease receivable. At what value will we debit the lease receivable? 57,500 into the 10.19% for a period of 3 years, plus there is a 10,000 UGRV into again for the 3rd year. So if I do this working, this will be 57,500 into 2.48 and 10,000 into 0.7474. This comes to 1,50,000. So let's say lease receivable is debited by 1,50,000. Now what will I credit? Sir, I will credit sales. It's like a credit sale entry, debtor account debit or lease receivable account debit to sales. Sales will be credited at what? 1,50,000 minus the PV of UGRV. Minus the PV of UGRV. So this is 1,50,000 minus 7474, which is the present value of the unguaranteed residual value, because 115 says that you cannot recognize the revenue till the time the customer is not going to agree to pay. Customer is agreeing to pay 57,500 over 3 years. For 10,000, no one is going to pay anything, and hence you cannot book a sale for that. And hence over here this is 142,526. Now ideally this is my credit sale entry. However, if I look at the COGS entry, COGS account debit to assets. So COGS will be debited by 1 lakh minus the PV of UGRV in line with the institute solution, and hence you get 95,026. Sir, I don't get 95,026. 1 lakh minus 7474 comes to around 92,526. However, in this question there is also an initial direct cost of 2,500. What institute does is they are also cramming everything into the single entry. So they are saying something account debit to bank. For initial direct cost, this is 2,500. What will I debit? Ideally, I should have debited the initial direct cost. But ultimately, this is going to go where? Sir, in the profit and loss account. And as a result, what will I do? I will debit, for example, the profit and loss by another 2,500, which is pertaining to the initial direct cost. So over here, this is debited by another 2,500, and that is about it. So that kind of takes care of your question number 59. Now, there is another question. Okay. that is your initial entry. But if I want to see how the working will flow throughout, well, see, asset is derecognized, no problem. Sales are taken to P&L, COG is taken to P&L. It is only lease receivable. So once you pass this entry, in every other year, the lease receivable 1,50,000 plus finance income minus payment comes to a closing again in the second year, again in the third year, and in the third year you land up to 10,000. So over here in each of the year, lease receivable account debit to finance income, bank account debit to lease receivable. Slowly you reach up to 10,000. Now after, let's say 3 years, for 10,000, I will get the machinery back. So your entry will be inventory account debit to lease receivable. And assuming this inventory is sold for 10,000, you will again pass the entry bank account debit to sales and then COGS account debit to inventory, assuming it is a normal inventory. If it is unsold, that inventory will continue to appear. If it is sold at a different amount, there will be a profit or loss again that is to be recorded. So this question gives you a fairly good run through of the entire set of adjustments. And after that, there is another question, I think question number 38, where this residual value adjustment is a slightly more complex adjustment if I were to review, and that kind of will take care of the lessor accounting as well. Okay, so let us review this. S enters into a 10-year lease of equipment. Equipment is not specialized in nature and is expected to have alternative use at the end of 10 years. That is fine. Lessor receives an annual payment of 15,000 payable at the end of the year. So that is fixed payment. Expects residual value of the equipment to be 50,000. This is expected at the end of the 10-year term. This point we will review in some time. The equipment has an estimated remaining life of 15 years. So if I do 10 divided by 15, that is around 2/3, 66.67%. It is not a major part of the economic life. The carrying amount is 1 lakh and the fair value is 1,11,000. Lease does not transfer ownership and does not contain an option to purchase, which means it is not of a specialized nature, does not transfer ownership, no purchase option, does not cover a major part of the economic life, which means again if you want to do the assessment will be if your present value of minimum lease payments excluding the UGRV cover substantially the fair value, and the fair value is around 1,11,000. Interest rate is 10.078%. How should the lessor account for the same in the books? Assume there is a dealer lessor case. So what I will try to do is I'll have to first assess for finance lease, and hence that is 15,000 into the present value annuity factor at a particular rate for a period of 10 years, 10.078% for 10 years, which will come to around 6.1240. Now there is one adjustment which is a little complex, which we had yet to review, which is lessee provides a residual value guarantee that protects the lessor from the first 30,000 of loss from sale at a price below the estimated residual value at the end of the lease term. So if your actual selling price comes to 50,000, that means there will be a loss of 0. You expected it to be sold at 50,000, it got sold at 50,000, lessee does not have to pay anything. But if your actual selling price comes to 0, then there is a loss of 50. Will the lessee have to pay the entire 50? No, sir. So your guaranteed residual value payment over here will be, well, we expected 50, we got 50, there's 0 loss, lessee does not pay anything. But if your sale proceeds are 0, lessee has said that if the loss is 50, I will compensate up to 30. So 30 lessee will pay. If my actual selling price, for example, comes to 10 rupees, then there is a loss of 40. Lessee has said I will compensate up to 30. And as a result, lessee will still pay 30. But if your actual selling price increases, it becomes 20,000. There's a loss of 30. Lessee will pay that 30. But if, let's say, your selling price is 30,000, there's a loss of 20. Lessee will only pay 20. If the selling price is 40, there's a loss of 10. Lessee will only pay 10. So my thing is, the worst possible case, I will get a 0 selling price. Still, the lessee is going to pay me 30. And hence, out of the 50,000, I'm saying 30 is guaranteed. I'm going to get 30 come what may. Remaining 20 daily dicey, might get, might not get, and hence 20,000 is unguaranteed, whereas 30,000 is guaranteed. So when I look at, let us say, the payments over here, my 30,000, which is a guaranteed residual value, will be taken into the calculation. And hence, if I take this 30,000 as well, which was not there in the earlier case had initial direct cost, but it does not have the guaranteed residual value. In this case, there's a guaranteed residual value as well. It comes to 1,03,345. 1,03,000 divided by 1,11,000, and hence it will come to around 93%, and hence the lease is a finance lease. If it is a finance lease, I will have to recognize a lease receivable, that is the present value of the lease payments, which will be 15,000 into 6.12 plus 30,000 plus there will be another 20,000 as well for lease receivable. If you will also take the unguaranteed residual value, and if I total all of this, it will come to around 1,11,000. Let us say when I book the sales will be 1,11,000 minus the present value of UGRV and to asset. I will derecognize at 1 lakh, and COGS will be 1 lakh minus the PV of UGRV. There is no initial direct cost. Later, you will have lease receivable on which you will keep on recording finance income in each of the years at 10.078%, and you will keep on collecting around 15,000 in each year till you reach at the end when you will have, let us say, around 50,000 remaining in your account. So the only reason why you should do this is this additional adjustment on how should you consider if there is a guaranteed residual value. Otherwise, question 59 is a good enough question. So that kind of takes care of your accounting for the lessor. And then you have a few special cases. Within these special cases, I would say you can quickly run through. The only special case which is relevant is a special case pertaining to sale and lease back. So we'll first go into the special case pertaining to sublease. Now sublease is a very simple case where you have, let us say, a lease which is called as a head lease, and then you are giving this property out down into something called as a sublease. So there will be two lease transactions over here. In the books of the original lessor, your accounting will still be based on the operating lease and finance lease concept. In the books of the ultimate sublessee, your accounting will still be based on, let us say, the right of use asset or a short-term lease, etc. But in the intermediate entities, so over here there is entity X, for example, giving the asset down to entity Y, who is giving the asset down to entity Z. For entity X, this will be only a lessor, in which case you look at the operating lease or finance lease accounting. In entity Z, you will only look at the right of use asset or, let us say, the short-term lease exemption, for example. But in the books of Y, Y is wearing two hats. Y is first the lessee, in which case Y can recognize the right of use asset and the lease liability. And then Y is also acting as a lessor when he is giving the asset down to Z. So while Y is giving the asset down to Z, he becomes a lessor, the intermediate lessor, in which case you have to figure out that whether this lease, this sublease, this is called as sublease, this is called as a head lease. You have to figure out whether the sublease is a finance lease or an operating lease. And for doing that, what you will just look at is you will compare the sublease term. Let's say the sublease term is 4 years and the head lease term is 5 years. Now the asset may be having a life of 50 years. It does not matter. Does Y have the right to use the asset for 50 years? No. Y has the right to use the asset for 5 years, and out of those 5 years, he's giving up the asset for a period of 4 years, and as a result, we can say 80% of the life is transferred, and hence this will become a finance lease. So when you look at the workings, the important thing that you need to remember is, in case of a sublease, the original lease transaction is called as a head lease, the subsequent transaction is a sublease. When you look at the intermediate entity, while assessing whether sublease is operating or finance, we will compare the lease term, that is a sublease term, 4 years, with the remaining life of the ROU asset, remaining right of use asset, that is 5 years, not the underlying life of the asset. The life of the asset may be 50 years, but I am getting a right of use for 5 years, and hence I will compare the sublease term, that is 4 years, with the remaining life of my right of use, which is 5 years, and hence this will become a finance lease. Acha, यहाँ पे for MCQ purposes, this is important. These are two exceptions. When the head lease is a short-term lease, the sublease will always be classified as an operating lease. Well, it is very much possible that in head lease you have taken the asset only for 11 months and you are subleasing down also for, let us say, 11 months, in which case technically the sublease will be a finance lease. However, the law says that if the head lease is a short-term lease, then the sublease will always be an operating lease. Why? Because if you say that the sublease is a finance lease, sublease will tell you to derecognize the asset. Well, if it is a short-term lease, I would not have recognized the asset, only what will I derecognize, and hence it will become a little chaotic. So the standard says that if the head lease is a short-term lease, which is not the case in our example of 5 years and 4 years, but if it is a short-term lease, then the sublease will always be an operating lease. That is the first thing. Second, what we have studied earlier in recognition exemption, that if, let us say, there is a lease of a low value item, that can never be taken for a head/sublease. So if there's a low value item, we cannot ever say that that low value item will be allowed to be said as low value item if it is sublease. An intermediate lessor cannot account for head lease as a lease of a low value item, irrespective of the value of the item. if let us say there is a sublease involved, so the optional exemption is not available. These two things are quite important, I would say, from an MCQ standpoint, because they are very small finer points which the institute likes to ask when it comes to an MCQ angle. Sir, what will be the accounting? Well, we are talking in the books of the intermediate lessor. Usually when the sublease is a finance lease, I would have recognized the right of use asset and a lease liability. Now I'm giving it up, so I will derecognize the right of use asset, recognize the lease receivable. Sir, will I derecognize my lease liability? No, I still have an obligation to pay the original lessor. Even if I can't collect money from my sub lessee, I will still have an obligation to pay the original lessor, and hence I will continue to show the lease liability. I will also show a separate lease receivable, though my right of use asset will be derecognized. So lease receivable account debit to ROU asset, and if there is any gain or loss, you will recognize it. But if my sublease is an operating lease, then my right of use asset will still continue to remain, my lease liability will still continue to remain. In fact, I will just show a rental income. So if my sublease is an operating lease, there will be no entry at the time of sublease. Your right of use asset and lease liability will both continue to be recognized in this case. Okay, so there are a few basic questions which is largely pertaining to this 4 years, 5 years type of comparison to figure out whether it is an operating or a finance lease. Now the most important on these special cases, I would say, is the sale and lease back. Now what do you mean by sale and lease back, and when do you do a sale and lease back? Well, typically a sale and lease back transaction is a transaction which is, just a second, is a transaction which is financing in nature. So the question is usually, if I want to lease the asset back, why am I selling it in the first place? It is because I might need funds. Those funds can come from operations, operating activities, maybe they're falling short. I can go to banks or I can go to equity investors and I can raise money. Well, maybe it is falling short, and still if I cannot arrange funds, then I'll have to sell the assets, but I need the assets for my operations. So what I do is I sell the assets, get an immediate cash, and then lease them back. So this is a sale and lease back transaction. Now typically there are two transactions. If I were to do the working independently, I would say that, well, you know what, if I'm selling it, my entry should be bank account debit. Let us say whatever money I get, let's say 100 rupees I'm getting, to the asset. Asset is, let's say, having a WDV of 70. Bank account debit 100 to asset, let's say 70, and 30 rupees will be gain on sale. Should have gone into the P&L account. Now after this is if I were to do it independently. After this, when I lease back, let's say I lease back, so I am going to pay a rent, for example, I don't know, of 20 rupees, 15 rupees, whatever it is. So there is rent for, it's not for a short term period, it's not a low value item, so I'll create an ROU asset and lease liability. So great. Sale recorded separately, lease back recorded separately. Now Ind AS 116 over here says that I don't think that this is correct, because when I am selling, I ideally derecognize the risk and reward incident to ownership of the asset. However, when I lease back, I still continue to be involved in the asset, and hence to recognize the entire 30 while continuing to be involved with the asset is not appropriate, and hence I should only recognize the gain for the part which is actually, for which the rights are actually given up. So how will I find that? We will see that. Further, when I create a right of use asset, now there can be a bit of a complication over here. Like for example, if let us say your asset had a WDV of 70, carrying value was 70, sale proceeds were 100, that is very much possible. Now you can actually lease it back, and maybe on lease back, let us say your rent is, I don't know, 20 rupees. So 20 rupees for a period of 5 years, 10% our favorite rate for 5 years, this is, let's say, 3.791. So I will say that I am going to pay 20 into 3.791, that is around 75.82. Now the problem is, if I were to pass those entries independently, my entry would have been bank account debit 100 to asset, let us say 70, to gain on sale, let's say 30. We said we are facing a problem in 30. 30 is not the most appropriate because we are still retaining some rights. Why should I recognize 30? Secondly, I will say TKR, we will see, I will say ROU asset account debit to, let us say, lease liability. Yes, I have an obligation to pay 20 for a period of 5 years, and hence this will come to around 75.82. ROU asset will be debited by 75.82. Now the question over here is, if I do ROU asset and lease liability at 75.82, just a day back, when this asset was appearing in my book as an owned asset, it was appearing at 70. Just a day later, now I'm in an inferior position. I'm not even owning the asset. I'm just taking it on rent just for 5 years. But I'm measuring the asset at a value higher. So this is also where the standard says a problem. The standard says, no, ideally a day earlier, if the asset which was owned was appearing in your books at 70, you still retain some rights of the asset, you give up some rights on the asset. So to the part which is given up, you calculate gain or loss. but for the part that is retained, you calculate proportionate value of the asset. You don't recognize 75, because if you recognize the asset at 75, a reader will be kind of baffled. They will say a day back when the asset was not even rented, it was owned asset, you were telling me that the asset is worth 70. Now a day later, when it is an inferior, it is a rented asset, it is now worth more, that is 75. And hence the standard says these are the two places where you will have to do an adjustment. You will have to find the gain or loss as proportionate gain or loss, and you will have to calculate the ROU asset value as a proportionate ROU asset value. So these are the two things that you have to somehow manage. So how do I do that? Well, I will recognize the ROU asset in proportion to the rights that have been retained. How will I find the rights retained? Well, I will say that today the fair value of the asset is, for example, 100 rupees only. Now, if the fair value is 100 rupees and I am paying 75.82, if I want to retain all the rights back, I should be willing to pay approximately 100, but I'm not paying 100, I'm paying 75.82. So it is reasonable to believe that 75.82 of my rights would have been retained. The fair value is 100. I am still paying 75.82, so I'm paying approximately 75.8% of the fair value. So maybe I'm retaining 75.8% of the rights, and hence my proportionate ROU that should be recognized should ideally be 70, which was there earlier, into 75.82 upon 100. Whatever is this balance which is coming up, 70 into, let us say, this comes to 53.07 or something, let's say approximately 53. So I will recognize my proportionate ROU asset at 53. Sir, what about the gain? Well, I will say that the gain entirely is 100 minus 70, that is 30, but that is if all is sold. I can say out of which something is retained and something is transferred. I can say approximately, and this is a longer version, I can say 75% as I took in the ROU approximately is what is retained, which means the balancing figure is transferred. So I can say that 30 into 75.82 upon 100, which will come to 30 into, let us say, 22.8 approximately, will be the gain pertaining to the rights which are retained, which means the balancing figure. You could have done this directly, which is around 7.2 approximately, will be pertaining to the parts transferred. So if I were to pass a journal entry, my journal entry in a regular case will be bank account debit, I am receiving 100. 2, I will de-recognize the asset which is at 70. Now I will record a lease liability because ideally I have to pay 75.82 only. Now the adjustment that I will do is, when I create an ROU asset, right of use asset, I will not be able to create ROU asset that entire 75.82. In fact, I will do it proportionately, which is around, I think, 53. And when I recognize the gain, I cannot recognize the entire gain of 30. In fact, I will recognize it proportionately, that is around 7.2. So approximately, let us say 7.2 or whatever it is. So if I look at this working, this is 153 on the debits, 70 plus 75.82, let us say, I say 75.8 only, 75.8 plus 7.2 if I do my entry tallies. So this is my entry when I look at a sale and leaseback transaction in a general case. Now the problem is, in most of the sale and leaseback transactions, these are the typical entry in case of a regular sale and leaseback transaction, which is at the market terms. What if the sale and leaseback is off the market terms? And we'll do a sum for a better understanding of this. But what do you mean by sale and leaseback going off the market terms? It means that over here, when we are selling, ideally the fair value is 100, but I'm getting more, let's say I'm getting 120. So the 20 extra that I'm getting, is that for the asset? The standard says no. Then for what am I getting the 20 extra? Maybe there is a loan. If the asset is worth 100, you should be getting 100 only. But if they are paying you 120, maybe the 20 extra is for, let's say, a loan. In such a case, most likely your rent will also not be 20. It will be higher, maybe around 25. Maybe they will charge you a higher rent, because the so-called buyer, okay, sorry, it will be the other way around. Over here, when I am selling, ideally I should be receiving only 100, but I'm receiving 120. So my entry will be bank account debit 120. So my gain ideally would be 120 minus 70, that is 50. Standard says no. If that was just a sale, yes, but if there is a lease back as well, we believe that both of them are connected. So if there is a higher sale proceeds that you are getting now, you will have to compensate it. Maybe you need more money, so you're getting a higher sale proceeds, but you will have to compensate it by paying a higher rent. So maybe instead of paying 20, you will end up paying 25 of rent. So when you calculate, we will say that, well, you know what, there will be some amount that is 20 which is attributable to a loan. So what I'm repaying as 25 ka rent over a period of 5 years, this entire 25 is not attributable to a lease. A part of it is attributable because I'm getting a right of use. A part of it is because maybe there was 20 extra that I've received on which I have to repay. So there's a hidden loan. So over here, they will say that if, let us say, there is a sale and lease back of the market terms, that is selling price is greater than fair value 120, which is greater than the fair value, which is 100, or the rents are different, then there's a hidden loan. You will reduce the sale price by the loan element. So 120 minus 20 and hence 100 will be your effective collection, I would say, for the let's say asset transaction, and 20 is for loan. So it can go the other way around as well. We'll see that. But first, let us say we look at this core case. In case there's a hidden loan, you'll first find the off-market element, that is 120 minus 100. Usually you can also take it as a difference in the present value of rents, but let's say this is 120 minus 100. You then find the PV of agreed lease payments. The answers will be slightly different, but let us say for simplicity, this will be 25 into, for example, 3.791. The present value will be around 94 point. I have not taken exact values, there will be some rounding of errors, but let's say this is 95.7, 94.78 approximately. Now, if I look at PV of dedicated lease payments, I will say no, agreed payment may be 94.78. However, if I tell them to repay the loan immediately, in today's terms, 20 rupees will be the payment attributable to the loan. And hence if I deduct 20 from this, around 74 point something is a payment which is exclusively for the lease. 74.8 is approximately the payment which is exclusively for the lease. Okay, so that's approximately 75%. ROU asset will be the WDV, which is 70 into PV of the dedicated lease payment, that is 75 approximately, upon the fair value. So I am saying that no, someone will say you are paying 94, you are not paying for the asset. We are saying 100 ka fair value of asset, we are paying 94, which means we are retaining 94 or 95% of the rights. No, out of this 24, 20 is attributable to the loan repayment, because if I were to tell them to repay the loan immediately, they will repay 20. In which case, 75 is for the lease in today's terms, and if I want to take the asset back, I'll have to pay 100. So 70 into 75 by 100 comes to approximately again 53 rupees. So this is your proportionate ROU. Gain or loss will be recorded again as fair value minus WDV, 100 minus 70, that is equal to 30. You will not take the selling price as 120 anymore. You will say that out of this 120, 20 is for the loan. So the remaining, the gain or loss will be calculated based on 100 minus let us say 70, that is equal to 30. So the rights which are retained, you will find the gain or loss, and the balancing figure will be attributable to the gain which is recognized. Okay, in the subsequent years, if the split between annual lease and finance and lease elements are required, institute usually avoids doing that. If, let us say, you look at a lease liability and a loan liability, so the journal entry over here will be, everything remains the same. Bank account debit will come to, let us say, 100 ke badle 120. ROU asset is still approximately 53, gain is still approximately 7.2, lease liability is around 75, loan liability is around 20. Now, rather than showing lease liability, which will ultimately be recorded using amortized cost principles, loan liability, which will also be recorded using amortized cost principles, institute usually takes a combined view, and it shows a total liability of around 95. Though you have to follow these steps for correctly finding the proportionate ROU asset and proportionate gain or loss. So the steps over here is, you first identify the off-market element. Second, you find the PV of agreed lease payments. Next, you find the PV of dedicated lease payments, that is your agreed lease payments minus, let us say, if there's a hidden loan. Then whatever is the dedicated lease payments divided by the fair value will be the amount that you are actually paying for the rights that are retained into, let us say, the WDV, that is a proportionate ROU value. For that proportionate ROU value, what will be the gain you find? That will not be recorded because those rights are retained, and the balancing of the gain will be recorded, and that's about it. Acha. Buyer lessor will not recognize any lessor will recognize the asset and the hidden loan if any, and subsequent accounting will be based on finance lease, operating lease, as the case may be. Now the sum that has come in the study material as well as in the exam is for a hidden loan, but it can also go the other way around, where the selling price is, let's say, 80, which is less than the fair value, which is, let's say, 100, in which case it is like that 20 rupees. Why will I agree for 20 rupees less? Well, probably I'm getting 20 less now, but I'll pay lesser rent. Instead of paying, let us say, a rent of 20, I will probably pay a rent of only 15. And as a result, the standard believes that when I'm taking my PV of dedicated lease payments as only 15 rupees into the PVAF, that is not what I'm paying. That I'm paying only, but initially cash inflow that was avoided. Ideally I should have received 100, I'm receiving only 80, that is 20 that I'm not receiving. Cash inflow that is avoided is similar to a cash outflow, and as a result the 20 that is kind of in a way spent will be taken as your cash outflow in this working. That is like a prepaid rent. So when I find the PV of dedicated lease payments, it will be 15 into the PVAF, yes, plus that 20 which is also an initial payment for the lease. Why would I agree to pay to receive only 80 when the fair value is 100? Probably for that 20 that you are not collecting now, maybe buyer does not have money, so you are saying, okay, you pay me 20 less now, but then I will pay you proportionately lower rent, and hence for the right of use what I'm only paying is not 15 into the PVF. 15 into PVF to hai hi, plus also 20, and that is the exact same working. So over here this is a hidden prepaid rent or a lease payment. You'll increase the PV of the dedicated lease payment, PV of the agreed lease payment by the prepaid element, and the corresponding adjustment will help you to calculate the proportionate ROU correctly. All of this will happen usually when the control sale will result in control being transferred. So then it is a sale, you will de-recognize the underlying asset and recognize a proportionate gain or loss. But if the control of the asset is not transferred only, like sale and repurchase, you are selling the asset, taking it on rent, and there is an agreement to repurchase it back necessarily, in which case the control is not transferred to the buyer, in which case it is more like a hidden loan, purely hidden loan, where I'm giving the asset as a collateral, a security. If the control is not transferred, then you account it as a loan, bank account debit to loan, and none of these workings will be required. So for this we will try to review an important question over here, which is question number 42, which is pertaining to the sale and leaseback case. So let's review question number 42. It is one of the very important questions. An entity who is selling a building to another entity for a cash of 30 lakhs. So this is your sale proceeds. Immediately before the transaction, the building is carried at cost of 15 lakhs. So this is where WDV. At the same time, the seller enters into a contract with the buyer for the right to use the building for 20 years with an annual payment of 2 lakhs payable at the end of each year. So this is your lease payment of 20 lakhs. 2 lakhs for a period of 20 years. The terms of the transaction are such that the transfer of building by the seller satisfies the requirements of determining that a performance obligation is satisfied under 115, which means control is transferred. So control of this building is basically transferred to the buyer, and hence there can be a possible sale and a leaseback. It is not just a collateral. The fair value of the building at the date of sale is 27 lakhs. So this is the fair value given. Now the problem is the sale price is 30 lakhs, the fair value is 27 lakhs, and hence there is a hidden off market element of 3 lakhs. You guys tell me, is that a hidden loan or is that a hidden prepaid rent? What do you guys think? We'll read it further. Initial direct cost, if any, are to be ignored. The interest rate implicit is around 12%, which is readily determinable by the seller lessee. Buyer classifies the lease as an operating lease, that is fine. How should the transaction be accounted by the seller and the buyer? Now in this case, if there's a sale and lease back, the first step over here is always to identify the off-market element. Well, the selling price over here is 30 lakhs and the fair value is 27 lakhs. So basically 3 lakhs is the off-market element. Now for 3 lakhs, I'm getting 3 lakhs more. It's not that I'm paying, that is, I'm not getting less, I'm getting 3 lakhs more. This is a hidden what? That is right, it is a hidden loan transaction. So over here off market will create, let us say, hidden loan. Second, I will try to find the PV of agreed lease payments, that is 2 lakhs into the PVAF at the rate of, let us say, 12% for a period of 20 years. If you do this working, you will get around 14,93,880. Now this is the total payments. Now वैसे तो you are going to pay 2 lakhs into 20, that is you are going to pay 40 lakhs, but that is over 20 years. In today's terms, that is equal to 14,93,000. Is that purely, exclusively only for getting the right of use? No, sir. A part of this will be for the loan. Well, I've received 3 lakhs loan, and if someone tells me to repay the loan immediately, 1493 880 minus 3 lakh, which is for the loan. So this is 11,93,880. This is dedicated for the lease only. So I would say that out of this, I would say 11,93,880 is attributable purely to the lease. And as a result, if I want to find the proportion of the right of use asset, if I want to find the proportion of the ROU asset, how much will be the proportion of the ROU asset? We will say that, well, the ROU in my books is appearing at 15 lakhs for the entire owned asset. Now, if I want all the rights, I'll have to pay 27 lakhs. However, I'm agreeing 11,93,880. I'm agreeing to pay, and as a result, just a second, and as a result, if I do this working, there would be proportionately 6 lakh. 63,267 will be the proportionate ROU asset to be recorded. Usually ROU asset is equal to lease liability, but not in case of sale and leaseback questions. In such cases, ROU asset is not equal to the lease liability. Now it comes to around 6,63,267, which is a proportionate carrying value. Now the gain, if I were to calculate, I would say that ideally my selling price may be 30, but my fair value is 27. So 27 minus 15, that is equal to 12 will be my gain, but this is for all. A part of this are rights retained, on which gain should not be recorded, and hence for the balancing figure, that is a parts transferred, the gain should be recorded of 6,69,387. A student might even do it directly. They can always say 12 lakh into, let's say, 27 minus 1193, whatever comes upon 27 lakhs. That will give you directly the gain attributable to the rights which are transferred. Now, if I were to pass a journal entry, my entry will be bank account debit. How much am I receiving, sir? 30 lakhs. Acha, samne, what am I giving up? Well, asset, building, worth 15 lakhs. Acha, now this is pertaining to the sale. Now for lease back, I will ideally recognize the ROU asset and the lease liability. The lease liability will be 1193. And there's a financial liability, that is loan, which is worth 3 lakhs. Now what ICI does is, they combine this and show 1493. That is also possible because both of them are ultimately accounted using amortized cost principle. And then the two items for which this entire working is done is the ROU asset, proportionate, and the gain on transfer, which can also be taken as a balancing figure, or we can actually find it using the working as above. So this will take care of the working in the books of the seller lessee. Subsequently, this 2 lakhs which is there will be attributable. A part of it is for the lease, which is 1193 upon 14, and a part of it is for the loan, that is 3 lakhs upon 14. So this will attribute the 2 lakh payment if I have to show it separately. In the books of the buyer, I will recognize the building at 27, but am I paying 30? Well, 30 may say there is a 3 lakh loan, and hence this is the accounting that will be happening. It is operating lease, and hence every year you will record rent income. Out of the 2 lakh income that I am receiving, again around 40,000 is attributable to loan, that is towards the loan, and the remaining 1,59,000 will be recorded on a straight line basis as a rental income. So 1,59,000 is attributable to rent, and the remaining 40,000 is attributable to the loan. It's probably one of the most important and complex questions which are there, and that kind of takes care of even the special case pertaining to the sale and leaseback. Now after this, there are two other things which are, I would say, not really important. One is the lease modifications in the books of the lessor. Now on this, earlier there were 3 questions. We have still kept it, but Institute has removed each of these 3 questions from its material. Maybe they are linked to COVID, so they had removed, but there can be a question pertaining to this, though because they have removed from the study material, there's a very rare chance of this coming. And lastly, there is a transition approach. This was actually applicable in the financials on 1st of April 2020 when an entity was adopting Ind AS for the first time. Now we are way past that date, and hence it is very rare that a question on this can come, but Institute ka bharosa nahi, so we are kind of preparing for these two, though these two are not really important from an exam perspective. Let us quickly just touch upon that. So when you look at the lease modification in the books of the lessor, we studied lease modification in the books of the lessee. Similar principles apply over here even in the books of the lessor. Like if, let us say, the lessor is giving an additional right of use, like I had given ground floor, now I am also giving first floor. If I am giving an additional right of use and that is at the standalone price, still in the books of the lessor it will be treated as a separate lease. That separate lease you assess whether it is operating, finance, you would not touch the existing lease. So even if it is lease modification, In the books of the lessor, if there's an additional right at the standalone price, it will be accounted for as a separate lease. However, if let us say it is not an additional right of use and not at standalone price, then it is treated as modification of the existing lease. Now over here, the modification is slightly more complex. Here, because there's an operating and finance lease, you first have to figure out that your existing lease by the lessor, was it a finance lease or operating lease? Let us assume it was a finance lease. For existing finance lease, now you might have given the asset out on rent for 10 years, and let us say the life was also 10 years, in which case it was a finance lease. Now 3 years down the line, that is 7 years are remaining, the lessee comes to you and he says, I cannot continue for 10 years, I want this only for maximum 2 more years. In which case, maybe I'll have to reassess from finance lease to operating lease. So the first point over here says that after modification, whatever are the revised terms, if they were applicable on the commencement date, will this lease be an operating lease or a finance lease? Like 3 years have gone by, as per the modified conditions, 2 more years are remaining. So 5 years out of 10, 5 years out of 10 will result in what we call as a operating lease. In which case you will have to reassess from finance lease to operating lease. If it was a finance lease, you would have derecognized the asset, you would have shown a lease receivable. Now if it is becoming an operating lease, then you have to bring back the asset. So I'll have to debit the asset. But what will I credit? Well, I will credit the lease receivable. The deemed value at which the asset will appear will be the lease receivable, which is currently appearing. After 3 years, you might have done a working and come to a lease receivable balance. Now I'm saying that due to the modification, the lease becomes an operating lease. So the lease receivable has to be credited and the asset has to be brought in. The value at which lease receivable is credited will be the same value for the asset. Check if the modified terms were applicable at lease inception. Will this still be classified as finance lease? In our case, no. It would become an operating lease. If yes, then you treat it as a termination of the existing lease and creation of a new lease, a new operating lease. In such a case, the underlying asset will have to be brought in, and whatever is the lease receivable balance will be the balance of the underlying asset. Secondly, if let us say you modify it, same case, let's say it was for a period of 10 years, 3 years have gone by. Now ideally 7 years are remaining, we modify and say that instead of 7, let us say 6 years are remaining, in which case the lease still continues to be a finance lease only. In which case your working will be similar to what you used to do for the lessee, that is, you will find the revised lease receivable. Step number 1, find the existing lease receivable. Step number 2, find the revised lease receivable as the present value of the remaining cash flows, and the gain or loss in this case will go to the P&L. Earlier you used to adjust the ROU asset, here there is no asset, no ROU asset, and hence the gain or loss will go to the P&L after considering everything. If there is yes, it is still a finance lease, then you will remeasure the lease receivable based on the revised terms, and the gain or loss, if any, will go to the profit and loss account. What if it is an existing operating lease? If it is an existing operating lease, then the asset is already there in your books. Then the standard says it is very simple. You will treat it as a termination of the existing operating lease and creation of a new lease. And as per the new lease, as per the new terms, if required, a straight lining will be done, and that straight lining will consider the deferred rent if applicable. If there was some deferred rent which was still outstanding, that will be considered for the purpose of your new lease as well. So there are no, we have 2-3 sums, but they've been removed by the ICI, so we are not really going into that right now. But in case it comes in an MCQ or in an IBS, this chart or the theory behind this chart is still there in the study material, so they are still well within their rights to ask. But these are the principles. You treat it as a termination of the existing lease and start of a new lease. The revised rent for the future years under the new lease will be including the deferred rent balance, if any. So long story short, if there is, let's say, a termination in the books of the if there is, let's say, a modification in the books of the lessor, you will still see if there is an additional right of use at the standalone price, it is still going to be considered as, let us say, a separate lease. Else it is kind of treated as a modification of the existing lease. If there is a finance lease, then you see that if the original terms were applicable, will it still continue to be a finance lease? If yes, then you just remeasure the lease receivable with the gain or loss going into the profit and loss account. If no, then you will have to derecognize the lease receivable, bring in the asset at the whatever is the carrying value of the lease receivable. If it's an operating lease, in any case there was no lease receivable, the asset was already there in your books, so you will say that there will be nothing. You treat it as termination of the existing lease and creation of the new lease. If the new lease is a finance lease, then you derecognize the asset. If the new lease is an operating lease, then you continue to show the asset and find the straight line rent. But while doing all of this, if there's any deferred rent balance, that has to be considered while kind of doing the workings for the new lease as well. Okay, that is regarding lease modification, and then you have transition approaches. Now what happened in the year 1920 is the year when I would say Ind AS 115, or let's say 1st April 19, Ind AS 116 came into existence for the first time. Now it is way past that date, and hence for that transition, I don't know why every year when a new material comes, I see that hopefully this should have been removed, but it is still there, so we are discussing it. So there are a few transition things. That is, if I'm moving from the older standard to the new standard, what are the transition shortcuts which are given? The entity is not required to state whether the arrangement contains a lease or not, like that hidden lease, is it there or not? I don't have to see that. Secondly, in case of, let us say, a finance lease which was there earlier in the books of the lessee, I will continue showing the lease liability at the same balance, and the asset which was there, I will show it at the same balance. Now the only problem will happen if there is an operating lease. If earlier it was an operating lease, you are the lessee, you were showing rent account debit to bank, P&L account debit to rent. It was an operating lease. Now you move under Ind AS 116. For the books of the lessee, there is nothing called as an operating lease, in which case you will have to create a ROU asset and lease liability. How will I create it? So there are three approaches. First is a full retrospective, the most complex one. We'll keep that for the end. Then is modified retrospective, within which you will have an alternative 1 and 2. If it comes rarest of the rare case in the exam, you will solve in the easiest approach, that is modified retrospective alternative 2. What does it say? Well, 116 will apply for the first time on 1st April 19. We'll say forget whatever has happened in the past. Whatever the remaining lease payments, find the present value of the remaining lease payments, taking the rate as on 1st April 19, that will be your lease liability, and that will be the same ROU asset. So adjustment from 1st April 19 only, no retrospective adjustment restatement. Lease liability, which is equal to the ROU asset, will be the present value of the remaining lease payments based on the discount rate on 1st of April 2019. There will be no prior period restatement needed over here. This is the easiest. You will find whatever is the remaining lease payments, take the present value, that will be your lease liability, and that will also be the ROU asset. But in case, let us say you want to take the other approaches, full retrospective would mean that from the date the lease was taken, on that date, find what the ROU asset would be, what the lease liability would be, then do the depreciation, then do the amortization, reach up to 1st of April 18, that is the previous year of 1920, show, let us say, the adjustment in the opening balances for the lease liability, ROU asset, and it is a full retrospective approach. Now, considering 116 was applicable always. Discount rate will be the rate on the commencement date. Retrospective restatement from the earliest reported date will be done. So, I mean, most of the entities would take the modified retrospective alternative 2 only because it is easier. But if you want to fully retrospective restate, no prohibition on you doing that. And then is modified retrospective alternative 1, where the lease liability will still be the present value of the remaining lease payments from 1st April 19. But I want to retrospectively restate the ROU asset. Well, you can do that. ROU asset to be retrospectively valued, but you will take the discount rate on 1st April 19 only. Why will I do that? I don't know. If someone says I want to restate everything, then for you we have full retrospective. Someone says I don't want to restate anything, then we have modified retrospective alternative 2. But if someone says I want to restate the ROU asset but not lease liability, then modified retrospective alternative 1. And that's about it. There's a question on this, but I would say this is one of the few things that we can say that you can kind of even skip, because it is not something which, and if they ask you, it is very unfortunate, honestly. There is so much to ask, and if they put a descriptive question for this, which is already long time back gone, it is a little unfortunate. But nevertheless, so that kind of takes care of this entire discussion of Ind AS 116. It's a fairly detailed standard, and we've tried to cover every corner of this standard, and hopefully this will kind of help you in navigating 116 in a slightly more better way.